take a look at the futures then after a solid day on Wall Street. The handover to Asia, though, was more mixed. You were down on the Nikkei and a bit of a mixed picture in terms of mainland China. There is reporting that maybe they can ease up on some of those property curves. The futures, as you can see, are pointing just slightly lower in the session. Here now you have the open just a few seconds in. The FTSE 100 is currently flat in the first few seconds. We'll be looking across the financial sector on the back of a rising yield trajectory. What that means for technology as well. You had the strongest dollar in a year stateside. That continues the strength for the dollar. Yields above 1.6, down 0.2% on your FTSE 100, down 16 points. The Spanish IBEX lower by 0.1%. The CAC 40 in France is currently flat, lower by 3 points. And the German DAX as well, also flat. We will have a look now at the cross-asset board and see how things are playing out, particularly in light of that inflation print out of the UK at a near decade high, 4.2% year on year for the month of October. What that does in terms of building to the picture for the BOE as they consider possibly a rate hike. That is the view, that is the consensus now for the month of December. This, it seems, will strengthen that case. The Bloomberg dollar index currently unchanged after that strength, again at a one-year high. The pound has strengthened, given those gains yesterday, building on those gains, up 0.1%, 134. The German Bund, you can see that it's currently at minus 0.24, yields slightly lower. In terms of the spot gold, you're looking at strength continuing for the yellow metal, gaining 0.3%. Let's look at some of the individual stocks then. We have some more earnings upgrades in terms of revenues and also some stales when it comes to Glencore. We've been talking about this on the previous hour. Glencore selling off some mining assets over in Australia for about $1 billion Aussie dollars. Siemens Healthineers raising their outlook for revenues and earnings, gaining 2.4% on the back of a strong outlook for health services. And SSE, we're speaking to the CEO, Anna Edwards, was earlier, down at 3.5%. They are looking at a 5-year investment plan and selling minority stakes in their transmission and distribution businesses. The stock falling 3.5%. Okay, European equity markets opening mixed there, and that's after gains in the US, as we discussed, being bolstered by that robust economic data, retail sales, highlighting the case for tighter monetary policy. Federal Reserve Bank St. Louis President James Bullard said the central bank should speed up its reduction of monetary stimulus. He said he doesn't expect rates to hit as high as 3 or 4%.
That's not my base case right now. I've got rates only rising to where they were pre-pandemic. This rate policy and tacking hawkishly now could pay great dividends for the committee in the year ahead or the 18 months ahead, because it means that we would have to do less later on and you'd smooth this whole process out some. The inflation rate is quite high. The core PCE inflation rate, the committee's favorite measure, is about 3.6%. That's the highest it's been in 30 years. So I think it behooves the committee to tack in a more hawkish direction. We could move faster. We kept optionality on this, that we could speed up the taper if it's appropriate.
Okay, joining us now to discuss the markets in depth is our markets editor, Christine Aquino. Christine, thank you for joining us on set as ever. We heard there from James Bullard then, putting the case that there needs to be more aggressive action when it comes to the taper from the Federal Reserve. The retail sales number out of the US was strong, of course. The markets, the equity markets reflected that, as did the US dollar. Does anything change in terms of how we should be viewing the taper timeline from Jay Powell and co?
Well, I think beyond the taper timeline, the thing to consider as well is when the Fed will start raising rates. I think there really is the big question that markets are looking out for, given that tapering really is kind of a done deal at this stage.
So markets are looking through and past the tapering at the moment. It's all about the rate hike cycle.
Absolutely. Okay. And I think the big debate there is how much they're going to go in 2022, when the first rate hike is going to start, and how much they're going to do over the cycle, right? At the moment, I think there's just over 25 basis point rate hikes priced for the Fed in 2022, but there's certainly room to increase that, especially if we get more hawkish commentary from the likes of Fed's Bullard, as well as the other members of the Federal Reserve Committee. And also, of course, we're watching for who the next Federal Reserve Chairman is going to be, or the next Federal Reserve Chair is going to be. I think it's a battle between Brainard and Powell at the moment, and we're expecting to hear President Biden's pick for that very, very soon.
Yeah, in the next 4 4 days, is what the president has said. So we're watching that very closely. It seems like, according to some commentary, Brainard is now maybe getting something of a lead on Powell. To what extent is this priced in by investors? On some measures, both very similar in terms of the dovishness of the stance. It's when it comes to the regulation of the banking sector that there's the difference. So investors, will there be a surprise, do you think? Will there be a sharp move lower if Brainard gets the pick?
I think, when we first got the whispers of the possibility of Brainard being the Federal Reserve Chair, that's when we got the initial reaction to that. And so now I think it's on the market's radar. It probably won't be that much of a surprise. But yes, absolutely. I think the big questions here when it comes to Brainard is when it comes to regulation, when it comes to longer-term approach for Fed policy, again, how quickly the Fed is going to go when it comes to its rate rising pace and longer-term trajectory of rate hikes in general.
Okay, and talking of rate hikes, of course, we had that inflation data out of the UK, 4.2% year on year for the month of October, higher than the estimates at the 10-year high now. Is a rate hike for the BOE in December now baked in?
Definitely, as far as the markets are concerned, Tom.
But they got it wrong last time.
Exactly. So that is the big question again, right, for the BOE. I think it depends now on whether markets are, or whether the BOE is going to align with markets this time around. What they do have this time that they didn't have in November is more data on the labor market, especially after that post-furlough period, right? I think that was one thing that was missing in their arsenal when they were trying to decide on rates in November. And now they have that. They also have additional data, again, from the CPI perspective, and a lot of that we can see is energy driven, but I think combined with the labor market data, the BOE is going into December's decision with a bit more information than November.
Yeah, and Andrew Bailey has stressed the importance of the labor market. There was an interesting survey by the Bank of America saying that 465,000 people here in the UK have disappeared from the workforce, pointing to that tighter labor market. And a line crossing the terminal right now, the UK 10-year yield rising above 1% for the first time, which points, of course, to your note that the markets are pricing this in terms of the rate hike in December. Christine, thank you very much, as ever. Christine Aquino, our markets editor. Let's cross over to Singapore then, where our co-anchor, my co-anchor, Francine Lacroix, is at the Bloomberg New Economy Forum. Francine, I hope we've got you. I think we're trying to line up the connection. I know we got a line of excellent guests and executives and interviews that we have on the agenda. You're going to be conducting them for us. What is the mood in Singapore, and what is on the agenda today? Good morning, Francine. Good afternoon for you.
Hi, Tom. Yes, well, I have to say a lot of the conversation is actually on inflation. A lot of the conversation is on the energy bust-up that we saw over the last couple of months and exactly what that means for a lot of the businesses represented here. So we'll be having a great conversation with the Goldman Sachs Chief Executive Officer. That's very shortly, David Solomon. I'll be asking him not only about what he saw in Glasgow and actually how finance can help the transition into a greener economy, but we'll be talking about the markets, we'll be talking about China, and of course we'll be talking about inflation. Other things coming up, of course, we'll talk about exactly the relationship between President Biden and President Xi. Our editor-in-chief, John Micklethwaite, had a great conversation with Gina Raimondo a little bit earlier on, saying that they will pivot to Asia, or certainly they'll come up with a new foreign policy on Asia in 2022. So all eyes on Singapore from the Bloomberg New Economy Forum.
Yeah, Francine, it was fascinating to hear, of course, the secretary there, Raimondo, in Singapore, talking about the need to shore up supply chains and building out those relationships with Singapore, Japan, and others in the region. And also Kissinger saying, look, this was a first good step in terms of the summit between the presidents, but you've got to see concrete action on the ground.
It was one of the highlights, and of course, we're just getting started here. So it's day one, and then we'll have much more on day two.
Okay, co-anchor Francine Lacroix on the ground for us in Singapore at the New Economy Forum. And you can be listening in, of course, to the conversation with Goldman Sachs CEO David Solomon in just under 30 minutes' time. Make sure you tune in for that. Coming up, UK inflation, as we mentioned, jumping to a 10-year high. We take a look at the factors pushing up prices and what that means for the BOE next. This is Bloomberg.
engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is, is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Morning traders, how are you doing today? I'm going to place an order to buy British pound, and the price I'm looking to buy 134.369. Okay, all of you guys who got the strategy, use the strategy. Indicators show us that it's time to place an order to buy British pound at 134.369. Okay guys, stay safe.
Welcome back to the Open. We are 12 minutes into the European trading day. Gains of 0.1% across the European benchmark. The Stoxx Europe 600. You're lower, though, in the UK. The FTSE 100 on the back of that inflation data down more than 0.1%. Lower also in Spain, but gains in Italy, Germany, and some modest gains on the CAC 40 as well. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Msci is selling a stake in its electricity network assets to fund a net zero spending drive. The company expects to offload a 25% share of both its transmission and distribution grid assets, confirming a Bloomberg scoop. Msci has been grappling with pressure from the activist investor Elliott Investment Management to separate into two. Walmart shares fell the most in almost 9 months, despite offering an earnings beat and a positive outlook. The US retail giant signaled that it's bracing for more pressure from the supply chain squeeze. CEO Doug McMillon said costs are rising faster than prices due to transportation snarls and higher fuel costs. Peloton shares jumped after its $1 billion stock offering drew the interest of major investors, a sign Wall Street is ready to look past a grim forecast earlier this month. The stock has plummeted 45% since the company said annual revenue could be $1 billion less than estimates. Peloton has been grappling with ballooning costs and weaker demand for at-home fitness equipment. That's the Bloomberg Business Flash. Tom Francine.
Laura, thank you very much indeed. Okay, UK inflation, as we mentioned, has climbed faster than expected to the highest in a decade, tightening a squeeze on living standards for households. That's also putting pressure on the Bank of England to raise interest rates. Let's bring in Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, surely the BOE now is going to have to hike in December. Is that the view on the back of this CPI print?
Yeah, what more does the Bank of England need, Tom?
Okay, the traders, we opened a new position on British pound. As you can see, we hold quite a few positions already on British pound. Also, we have short positions. We're already in profit. So, new position open for British pound. Use your strategy. If you don't have a strategy, you need to go to company.co.uk and get the strategy. Otherwise, stay with me and I will guide you through this trade until the end. Okay? And we'll make a profit, of course. Stay safe. I'll speak to you later.
December should just rubber stamp what's already a strong case for a December rate rise. And the fear now will be that worries about inflation mean price growth starts fueling itself.
Yeah, so everything seems to be coming together to make the case for that rate rise by the BOE in December. Let's unpack what's happening, though, with inflation here in the UK. What is behind this surge in prices? Beating estimates. What are the economists getting wrong? What are they missing?
Well, natural gas and electricity prices rose last month, and that's after the regulator allowed suppliers to hike tariffs to offset rising wholesale prices. They're expected to rise again in April at the same time as a planned tax rise. So unless the Bank of England steps in soon, this pressure on household finances could undermine the recovery.
Okay, Bloomberg's UK economy reporter Lizzie Burden breaking down the case then and what is factoring in again for the BOE and the members there as they consider the implications of all of this data, wages, CPI, inflation, as they look ahead to December and that important meeting. Thank you very much indeed. It's worth noting as well that the UK 10-year, it briefly moved above 1% for the first time since November 4th, currently at 0.994, but you would expect that yields will grind higher if we do indeed get that rate hike. The pound as well bumped up higher. You saw some pretty significant gains for sterling yesterday, and gains again, modest gains. They pared a little bit today on the back of that CPI data at a 10-year high. Okay, coming up, US Commerce Secretary Gina Raimondo says China needs to live up to its commitments. We'll hear more of that interview from our New Economy Forum next. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
that
I...
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the quarter three was the quarter that was most affected.
Welcome back to the Open. We are 19 minutes into the European trading day. The benchmark stock 600 holding on to gains of 0.1%, still at record levels after a very solid close for Wall Street on the back of those better than expected retail numbers. The economic data out of the US holding up, it seems, as concerns and amid concerns that inflationary pressures will linger. And of course, we heard from James Bullard suggesting that the Fed should speed up its taper. The handover to Asia was a little bit more mixed. You were lower in Japan, essentially flat over on mainland China. Investors there weighing up some changes possibly on the regulatory front. The futures, by the way, have turned positive in the US, gains of almost 0.1%. In terms of the sector breakdown here in Europe, you're looking at the gains as top of the list. Industrial goods and services gaining 0.3, 0.3%. Modest gains there. At the bottom of the list, travel and leisure down by about 1%. China also a factor. We heard from Kissinger at the New Economy Forum, of course, the Chinese Vice President Wang Qishan, and we've been hearing from US officials. China is not living up to its commitments from the Phase 1 trade deal. That is according to the US's Gina Raimondo. She was speaking at the New Economy Forum. She is, of course, the Commerce Secretary. Let's take a listen to what she had to say, particularly about supply chain issues.
You know, for so long in our supply chain, the mantra has been just in time. And now we realize the vulnerabilities of just in time. We need to move to just in case. We need to have redundancy. We need to have diversity. And so we are here, I am here in the region talking to companies that are in our supply chain and ministers here to say, let's collaborate with our partners. Tomorrow I'll be in Malaysia. A good part of America's supply chain is in Malaysia. Some of the factories went down due to COVID outbreaks, which had disruptions, obviously, in America. Some of the factories went down due to natural disasters. So we're saying, okay, how do we work better together? How do we improve resiliency and transparency so we get rid of these choke points and bottlenecks?
We have to talk about trade. We heard from U.S. Trade Representative Catherine Tai talking about a possible recoupling with China. In a new normal, in the area of trade between the U.S. and China, what is that exactly? How do you define it?
Yeah. Well, we want trade, obviously. We want trade that's good for U.S. business. Exports are good for U.S. business. But it needs to be, China needs to play by the rules. They need to respect our IP. They need to live up to their commitments. You know, right now, for example, in the so-called Phase 1 deal, where the Chinese committed to purchase a certain amount of, you know, aircraft and agricultural products, they're not doing that. They're not living up to their commitments. So, you know, we want a level playing field. We want everyone to play by the rules. And then, of course, we do want trade and exports, good for American business.
The U.S. has also talked about using new tools to address Chinese practices. What are these new tools? And are you looking at deploying these new tools along with your allies?
Absolutely. So President Biden is so clear about this. You know, first and foremost, we invest in America. You know, just 2 days ago, the president signed a $1 trillion package, biggest investment ever in American infrastructure. And then we work with our allies, which is why I'm here in this region. You know, we want to develop a more resilient supply chain with our allies. Here in Singapore, for example, or in Malaysia, or in Japan, they are key partners in advanced manufacturing in the supply chain. So we need to work with them so that...
But what are these new tools?
Well, that is part of it. So, for example, I am here laying the groundwork with these countries to come up with an economic framework for how we work with countries in this region on supply chains, semiconductors, digitization, cross-border data flows, really decarbonization. So going beyond the limits of a traditional free trade agreement to look at other aspects. Those are kind of additional tools.
And that was the US Commerce Secretary Gina Raimondo at the New Economy Forum speaking to Haslinda Armin. Now, China is said to be accelerating plans to replace American and foreign technology. It is quietly empowering a secretive government-backed organization to vet and approve local suppliers in areas from the cloud to semis. But at Bloomberg New Economy Forum, Chinese Vice President, in fact, Wang Qishan, vowed that China would continue to open up to foreign investment.
Openness brings progress, whereas isolation leads to backwardness. We need to promote trade and investment liberalization and facilitation, bring down trade and knowledge barriers, stay away from discriminatory and exclusive rules and systems, and keep the functioning of supply chains stable and smooth.
Okay, that was Wang Qishan speaking at the New Economy Forum. Now we're joined by Bloomberg's Bruce Einhorn out of Hong Kong. Bruce, what do you make of these comments by Wang Qishan? Do they square and do they match the reality in terms of China's position in its capital markets and on its trade front. There is an argument that China is actually looking more inward and has been more inwardly looking than it has done for years. And yet here is the vice president saying that China remains open for business.
Well, it's a good point. I think that, you know, what we're seeing from Vice President Wang Qishan is they're trying to strike a balance, right? It has been a Chinese priority for several years now to reduce the country's reliance on foreign countries for all sorts of vital technologies. So that hasn't changed. At the same time, for a long time, the country has also still wanted to attract foreign investment to be part of the global economy. So they're trying to strike that balance, and I think that's something that we're hearing from Vice President Wang.
What do we know about this secretive committee that Bloomberg's been reporting on in terms of technology companies that essentially have the green light, the backing of the government to sell their products into the Chinese economy? And what does it mean for foreign tech?
Well, it's not great for foreign tech. I think that we can clearly say that American companies, other foreign companies with large foreign ownership, they're not going to be part of that. So that's clear. I think that the priority is really going to be on giving business to Chinese companies. Those are ones that are, for obvious reasons, easier for the Chinese government to keep tabs on, to control, to be able to feel good about the technology.
All right. Bruce Einhorn, thank you very much indeed. Okay, don't miss the 4th Annual Bloomberg New Economy Forum happening throughout the week. More on that coming up, including Francine's interview with the CEO of Goldman Sachs. This is Bloomberg.
There's a pretty good chance that you use products made by Meta every single day. If you've never heard of Meta, that's because it's the new name for Facebook Inc., the parent company of Facebook, Instagram, and WhatsApp. All right, perfect.
In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. In the next 4 days, Joe Biden is still deciding between Powell and Brainard as Fed chair. The president rules out any other contenders. Inflation continues to loom large. St. Louis Fed President James Bullard calls for more hawkish policy. UK inflation surges to a decade high. And we are live from the Bloomberg New Economy Forum in Singapore. Later this hour, we will be speaking with the Goldman Sachs CEO, David Solomon. Every day this week across the European markets, you've seen gradual gains building on these record highs. It continues 30 minutes into the session here, gains of more than 0.1%. The breakdown, the divergence is there, though, between the FTSE 100 losing 0.2%, dragged down by SSE, the energy company that came out with its infrastructure and spending plans, strategy plans for the next 5 years, and selling minority stakes in its distribution transmission business. But you're seeing gains over in Germany of 0.1% and flat on the CAC 40 as well over in France. Solid session, of course, in the US. And you do have calls from likes of Morgan Stanley that you want to have more exposure to European equities. Credit Suisse, by the way, in the last few minutes, upgrading Japanese equities. And the Bank of America Fund Manager Survey pointing to that support, the highest level of exposure for US equities since 2013 amongst fund managers. Let's just switch it on and see what's happening on a sector-by-sector basis. You do have yields in the US above 1.6, so supportive for financials. We'll take a look at how that is playing out sector-by-sector then. 30 minutes into the trading session, of course, inflation remains a concern. We've been hearing from the Fed President James Bullard. He wants to see speeding up of the taper from the Fed. The ECB as well, grappling with those inflation concerns. And here in the UK, inflation getting up to a 10-year high, more than 4%, 4.2% year on year for the month of October, is then a Bank of England rate hike in December essentially baked in. I'm now seeing the GRR, basic resources at the top of the list, gaining 0.4%. Down at the bottom, travel and leisure falling more than 1%. Okay, let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. UK inflation has risen to its highest level in a decade, heaping pressure on the Bank of England to hike rates. Consumer prices gained 4.2% from a year ago in October, faster than all estimates in Bloomberg's survey of economists. The pickup was driven by natural gas and electricity prices after the regulator allowed prices to rise by as much as 12% to offset rising wholesale costs. Ireland is introducing some COVID restrictions as it struggles with rising hospitalizations. Prime Minister Michael Martin says people should work from home where possible, and cinemas and theatres will now require proof of vaccination. Germany has reported another record increase in cases and the highest number of COVID deaths in more than 6 months. Meanwhile, a report says US regulators could authorize Pfizer-BioNTech boosters for all adults by the end of the week. UK Prime Minister Boris Johnson is proposing members of Parliament should be banned from taking paid political consultancy work as he tries to draw a line under 2 weeks of damaging headlines for his ruling Conservative Party. The plan is a dramatic reversal from Johnson's position when he ordered his MPs to block the suspension of a former minister. The opposition Labour Party says the proposal waters down its reform plan. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Okay, Laura, thank you. Banks are poised to hand investment bankers and traders their biggest bonuses since the financial crisis. The hope is the cash will stem the high levels of turnover sweeping Wall Street. It is a contrast, of course, from last year's underwhelming payouts, with equity and debt underwriters appearing to be the biggest winners, with a jump of as much as 35%. Joining us to discuss these headline bonuses then is Bloomberg's Tom Metcalf. So Tom, underwriters doing well. What about everyone else? And such a change from last year.
Yeah, exactly. Well, those underwriters are definitely doing the best, up 35%, as you say, but it's pretty widespread. We're also hearing M&A deal makers are up about a quarter, same for equity traders. So basically the whole industry is set for, good bonus season.
I mean, there's been significant trading activity. We've seen that come through in the latest set of earnings for the banks. that is behind what's propelling these higher bonuses that we're expecting in February. Is there anything else that's behind this?
Yeah, no, it's really that. It's basically been a secular shift since effectively coronavirus, which, executives say, hey, look, capital markets are now bigger than ever. Obviously, you've had years of cheap money, so there's a lot of sort of investors' money floating around, and that's helped as well. And yeah, it's just a very, very good time to be a banker.
Who's going to be looking at this with a kind of the sourpuss approach? Who's going to be missing out on the big bump bonuses within the financial sector?
Well, there is one group, apparently fixed income traders. A bit of a surprise given how well they did in the pandemic. So they're apparently going to be down about 5%, but that is against a very strong comparative in that case. So I think they'll still be all right.
Do you have a sense, talking to your contacts, as to what this is going to do for staff retention? It's been such a hot topic, hasn't it, over the last 12 to 24 months?
Yeah, no, absolutely. That's top of everyone's mind, and basically that's the constant sort of complaint we hear from executives is basically we can't keep hold of our staff, and people are such demand for talent out there, so much sort of appetite for trying to keep up with business that people are just getting poached left, right, and centre.
Okay, Tom, thank you very much indeed. A bumper February for many within the financial sector is what's to be expected then. Tom Metcalf bringing us that story on bonuses. Don't miss the 4th annual Bloomberg New Economy Forum. That is happening throughout the week. This is your regular 10-minute, 15-minute reminder, of course, this important event for us. Coming up, my co-anchor, Francine Lacroix, will be speaking with Goldman Sachs CEO David Solomon. Maybe we should touch on the question of bonuses. We'll get that conversation shortly. This is Bloomberg.
Competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has 3 very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one-directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now. Into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open. We are 39 minutes into the European trading day. Stocks across Europe looking at gains of almost 0.2%, 39 minutes into the session. At the top of the list, on a sector basis, basic resources gaining 0.6%. Bottom of the list is travel and leisure. The FTSE 100 is lower, but you're seeing solid gains in Italy, 0.3%. Okay, switching focus to the corporates. Alphabet CEO Sundar Pichai has told Bloomberg that China and the APAC region remain central to its expansion plans. He spoke with Emily Chang at the New Economy Forum.
it's such a fitting time frame. I'm glad you're focused on the region. It's the most vibrant region we see. It's our 20th year since we opened our office in Tokyo. It was the first office outside the Bay Area. You have 2.5 billion people on the internet. There are many areas in which they're leapfrogging trends which are here and embracing the future. Digital payments is a great example. So many of our products originated from APAC, Google Maps, Google Pay. A lot of our journey to bring computing to more people is playing out in Asia as well. I am excited about also the work we are doing through cloud, because the companies there are rapidly transforming themselves digitally. So a chance to provide that is something very exciting for us. So super dynamic region. I feel like we are learning as Google, being in the region. And so I think it'll transform. The first 10 years, I would have said we took products here and brought it to APAC. Over the past few years, we are beginning to build things there. And some of our future global products will be APAC first and rest of the world later.
You can't talk about APAC without talking about China, and you're facing stiff competition from Chinese tech giants there and beyond. What should U.S. policy...
Okay, the CEO of Alphabet, Sundar Pichai, speaking to Emily Chang there in Singapore. Let's get back to the Bloomberg New Economy Forum now, where my co-anchor, Francine Lacqua, is hosting a panel with Goldman Sachs CEO David Solomon. Let's listen in.
Make our world more green is hugely important, hugely important. But I also think at the same point in time, we have to recognize that we're trying to drive very dramatic change and that we need sound government policy, solid action and activity by private sector market participants, significant capital allocation, especially in risk capital that can really drive technological innovation and change, and it's going to take time. And I think there's got to be a lot of dialogue. I went and I sat in a roundtable today with Mike Bloomberg and a bunch of other participants here where we talked about a variety of ideas to try to accelerate it. But I think there's a real agreement that while this is an urgent thing that requires attention, we have to be realistic that we're making drastic change in our systems, our processes, et cetera, and that this is going to take some time.
So what does it mean for finance? When is it going to be fully transitioned? And again, if some of these rules are not mandatory, do you worry that they won't have enough teeth?
Well, I can't answer the question when it's going to be fully transitioned. And remember that when we talk about this, we can talk about what's going on in the United States, or we can talk about what's going on in the UK, which is where you and I last saw each other. But what we're really talking about is what's going on the planet. And if you think about the developing economies and you think about some of the big economies in other parts of the world, we really have to make progress, broadly around the world. So obviously I think about the United States where I'm from, but I think about China, and I think about India, and I think about Indonesia, and I think about Vietnam, and I think about Brazil. I think about the fact that when you look at these big economies and the role they're playing, and they're less developed than maybe we are in some ways in the United States. Not all. China's obviously coming along, but the ability to really solve these problems on a global basis is going to take a long time. Now, finance and banks and other financial players are playing a meaningful role. Capital allocation's changing. I think one of the things that's having a big impact on markets is institutional allocators of capital are demanding different things from the companies they invest in. And they're thinking differently about the way they deploy capital, and that's having an impact.
And you've committed, Goldman Sachs has committed $750 billion to sustainable investments. Could you bring that up if everybody else does?
We created a framework where we said that over the next decade, we will commit $750 billion to advisory, financing, or investing capital to support a more sustainable planet broadly. And by the way, we define sustainability in a very broad sense. Of course, we talk about climate, but we also talk about inclusive growth. And we have 9 sub-themes that we think are very, very important to make the world broadly more sustainable. In the first year, we did about $156 billion. We track this stuff. We keep track of exactly what we're doing. My guess is over time, if we continue at the pace that we're at, we'll continue to expand that commitment. But that's one of the big ways that we as an organization can have impact is we can direct capital and resources to help companies and institutions drive transition in their business.
Yeah.
And I think that's our role as an intermediary or a financier.
And where's that transition coming from the most? Is it companies? Is it governments that need support? And what part of the world?
Well, I think I think that there are a handful of things that come up in every discussion that I have with a government, with a corporation or an institution. And one of those things is climate transition. And so this is a topic that is front and center for all at the moment. And it's coming up in everyone's conversations. I think there are companies and institutions that have a more urgent take on it. I think institutional capital, very aggressive in Europe, moving more to the United States. So there's a different level of intensity in these discussions depending on where you are. But I think the world is coming to terms with the fact that we all have to be investing in the future. And if we don't invest in the future, if we don't plan and think about how we're going to transition our businesses, that ultimately we put our businesses at great risk and our society at great risk.
And is this only because we're seeing, the economic recovery and things are looking brighter and the markets are going higher? Or do you think there's real commitment to go through this transition no matter what?
I think the commitment's real. I don't think this is a function of the market environment. I think the commitment's real. I think sometimes we get caught in a lot of high-level conversation, and that distracts us from the hard work on the ground, the blocking and tackling and the hard work on the ground, the investments that have to be made, and the need for thoughtful process. I mean, transition is just that. You can't have a transition without a process. So I don't think this is a moment in time. I think this is real. And if we do a good job, we'll make it more sustained, and we'll have a chance of accelerating it and improving the timeline perspective that we currently see.
When you look at the economy and you look at the markets, apart from inflation, what do you worry about?
Well, I think that we're at a complicated time because we normally don't have an event like a pandemic that forces us to shut down economic activity so quickly and so randomly. So we generally don't turn the light switch off and then try to turn it back on. And when we turned it off, it was like a light switch. We went flick. Now it's like a dimmer, and we're turning the dimmer up and slowly bringing the lights back up. And it's not a straight line. Obviously, the impact of the pandemic and the path out of the pandemic is different in different parts of the world and in different locations. And governments in different places are taking different actions based on their own perspective, based on their own experience. Somebody said to me yesterday, and I think it's very, very fair, if you lived through SARS, you've had a very different point of view about how to mitigate this than if you came from a place that wasn't really affected by SARS. And so I think that we're turning the economic environment back on, but because of this crisis, we've had a massive amount of monetary and fiscal policy all over the world that's having an impact. It's having an impact on asset prices. It's having an impact on inflation, as you mentioned. I think markets generally, when I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. And generally speaking, my experience says that, those periods are not long-lived. Something will rebalance it and bring a little bit more perspective. Certainly, given that it feels like inflation's rubbing above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
But are you expecting some kind of taper tantrum from the markets?
I'm not a good predictor. I've never thought of myself as a good predictor, but I certainly feel like the market anticipates higher rates at this point in time. The question is how much, how quickly. I don't think there's a chance that central banks can unwind this massive stimulus in a way that doesn't create some sort of a taper tantrum or some sort of a real shock to markets. But there's also a chance it can't be done that way. And I do think that people, it's been a long time since we operated in an environment where the general trend on interest rates has been higher and the general trend on inflation has been above trend. I got out of school in the early 1980s, and generally we've had the opposite, for that 35 plus years. And so, I do think people don't remember when Paul Volcker raised interest rates by 300 basis points on a Sunday afternoon. So there are a lot of factors that will go into, how this process plays out. It's unclear, but I certainly think that thoughtful market participants are thinking about it. In my conversations with big institutions, they're thinking about it and they're trying to balance the need to participate and have relative performance based on participation, and what happens as we unwind some of this and we rebalance a little bit.
So are you telling me that you're worried that, markets are too cool about it just because they've made money for the last 10 years?
Well, I do think that, generally speaking, everyone feels quite smart right now because most of the things that you invest in are going up. That's not the way it normally works. So again, I'm not a great predictor, but my experience tells me this is a moment in time that's probably not a sustainable moment in time.
But then it would be what, an economic shock? So away from an inflation monetary policy, what could it be?
It could be a change in the perspective of the course of economic activity. It could be some sort of a geopolitical shock. It could be that something goes wrong with respect to our emergence from the pandemic and we have a different set of events that change the perspective. But all of this is based on kind of confidence and a forward view. And, I would say at the moment, the forward view is quite optimistic. If it stays optimistic and central bankers, handle the withdrawal in an appropriate way with the right communication, there's a chance we can do it, in a balanced way. There's a chance something could go wrong. Got to be prepared for both.
How do you prepare, actually, for both?
Well, you prepare by, thinking about if the world looked differently, how would it affect different assets and, how would you feel if things were worth less? Yeah. Not worthless, but worth less. And so in that context, we talk to our clients a lot about different scenarios, and we think a lot about our own balance sheet and our own propensity for risk as we try to navigate those things.
Talk to me a little bit about China. So you're optimistic longer term in China. Do you ever get any pressure from Washington to grow less fast in China?
We're very committed to building our business in China, but in the context of the fact that Goldman Sachs operates, globally all over the world, and we serve governments and institutions and corporations all over the world. And given the importance that the important position that China plays economically in the world, you really can't be Goldman Sachs without participating in that. I wouldn't say there's direct pressure on us to change our long-term plans to grow our business in China. Is it possible at some point in time something goes on geopolitically between the U.S. and China, and because we're a U.S. company, there's either pressure or directive for us to do certain things differently? Sure, that's a possibility. But we think about this with a 10, 20, 30-year perspective, not with next couple of year perspective. And so we're long-term committed to continuing to serve our clients by having the resources and the capabilities in China that allow our clients globally, to participate in markets.
Do you worry that your license could be revoked at a moment's notice?
Well, we worked for 17 years to get it, and so we've only had it for a few weeks. So I'd like to think we'll hold on to it for more than a few weeks before it'll be revoked. But I think that China, after holding institutions like ours at bay in terms of taking control of our entities in China, I think China wants to grow its capital markets. They want more listing activity in Hong Kong or onshore. And I think the participation of global institutions in their capital markets strengthens their capital markets. And so my guess is they continue to support that, but the world can change.
The world can change quite fast. When you look at some of the shocks, and we mentioned some of the shocks as well, when you look at the prospects of China, how much do you want to grow in China, and how difficult is it to access, for example, talent in Hong Kong and to retain talent in Hong Kong because of the quarantines?
Well, I think it's important to put it in perspective that while, we have a business in China and it's a good-sized business and it's growing, it's actually a very small business in the overall scope of Goldman Sachs. Yeah. But given the economic activity there and the size of the economy, over the next 10, 20 years, it could obviously be a bigger percentage, of the business. And so we'll continue to serve our clients and try to allow it to grow. Talent acquisition is an important part of our business and something I've always been focused on. I think that we're a relatively attractive place for people to come work, to grow, to learn, to build a network, et cetera. We hire a lot of young people into our organization. One of the things I don't think people realize about our organization is that 50% of the people who work in our organization are in their 20s. And so it's a very, very young organization. And one of the reasons for that is because people feel that they can learn a lot and they can build a great network and they can get a great set of experience. And that's an important part of our ecosystem. I wouldn't say that I would say that we're going through one of those periods where it's more competitive for talent than it is in other periods.
Globally?
But globally. I do think that, there are some challenges. China, Hong Kong have a certain approach right now to COVID, and therefore they're relatively closed. This is my first trip to Asia since February of 2020, which would be very unusual. I'd be in Asia, 4 or 5 times a year normally. And I haven't been to Hong Kong or China, and don't expect that I'll be able to go for quite some time. And so, in the context of that, we have a lot of people that work and operate there. Many of them are local Chinese, but many of them hold passports from other parts of the world. And certainly being restricted in terms of leaving or coming back, the family pressures, et cetera, that's not a great dynamic for talent, but we're at a moment in time where we're going to have to navigate that. And that's certainly a headwind for global talent in that part of the world right at this moment.
Do you think it'll loosen up?
Well, I think ultimately, it should. It'll have to. I don't think it's going to loosen up quickly, meaning, in the next couple of months. But, I think economically, and it's just one person's view from the outside, when you restrict travel in and out, when you restrict the ability for people to come and visit, engage, for people to leave to go engage around the world, over time, it has an impact on your economic activity. And so, I'm sure that the leaders in China are thinking about that and balancing that based on how, they are, protecting, their population from COVID and executing on their plan. But at some point, I would assume that we'll get to a different place. I just think they're on a different path and a different trajectory based on their facts and circumstances.
What are you most excited about at this juncture in time?
Well, I continue to be incredibly excited about the amount of innovation that exists in the world. And all the great ideas and, all the change that technology and innovation are driving. And by the way, I'm excited about technology and innovation driving change around climate, where we started the conversation. I'm a big believer that we've got to find a path for more risk capital to get into really driving technological change that can help us, improve a bunch of the technologies that exist to make our world greener. But we've got to take the cost differential out. And I think we can really make progress. And we can complain about all the things that are wrong, but I'm quite optimistic that we'll do better than people think over some period of time.
And this is coming out of what region? And do we see enough partnerships, for example, on green technology between the U.S. and China?
Well, I think that this is coming out of a variety of different places where people are trying to innovate. Broadly, I do think that one of the great opportunities for China and the West to cooperate, is around climate and climate technology broadly. I think ultimately, though, governments are going to have to partner with risk capital to try to find ways to accelerate and make more investable, certain unknown technologies. And I'm hopeful that that's something that will continue to progress. But I just think the pace of innovation in the world is only accelerating. And that's extremely exciting. And some of the changes that are coming, think about these vaccines are an absolute miracle. They're an absolute miracle in the pace of change and what those vaccines and the technology behind those vaccines can do for other health issues and how we can continue to make progress on a whole variety of issues in the health and bioscience space. Just gives me a lot of optimism about the direction of travel.
Does it change our composition of the economies to a point where actually, that could be a market risk, disruption coming?
Well, it's life expectancy is a positive for economic growth. The more we can improve health and well-being in the world, the more we can get people around the world to participate because of their health and well-being or also extending life, that drives economic growth and economic activity. So, over time, there's lots of opportunity for growth in the world if we continue to make technological progress and continue to advance. And I'm just always, I'm a glass half full guy. I worry as a manager of our organization, I worry about what can go wrong a lot. but I don't wake up every day worrying about what can go wrong. I wake up every day being optimistic about what can go right, and then try to mitigate the things that will go wrong along the way.
What do your employees ask you the most? I know they've had, what, record bonuses? I think the best bonuses.
Well, we haven't paid any bonuses yet because we pay people at the end of the year after the year is over based on our performance. Certainly because our performance is good, compensation will increase this year because we're pay for performance-based business the way our business model works. But, our employees are focused on the things I think most employees are focused on today. First and foremost, they're focused on their health and their safety and their well-being. And I think one of the things that's been very challenging about COVID is just kind of the isolation of society. Generally, I think people are social animals. People want to be out. They want to be with other people. I hear it from our employees. They want to socialize. They want to connect. We're doing, depending on where you are in the world, we've got, reasonable amount of people back, participated in the office. But first and foremost, people want to be working hard. They want to be motivated. They want their families safe. They want their own, safety, security, and health. And so, we spent a lot of time, focusing on that for our organization broadly. Secondly, our employees are interested in what's going on in the world and, how Goldman Sachs as an organization is contributing positively to that. And I think all organizations, today have to be able to really articulate how they're trying to contribute to moving the world forward, moving our society forward. And our employees care a lot about that. And I think employees, everywhere care about those things.
David Solomon, thank you so much.
Absolutely. My pleasure. Quick 20 minutes.
That was our anchor, Francine Lacroix, speaking with Goldman Sachs CEO David Solomon. A really fascinating conversation, a wide-ranging conversation. Really started about turning the economic momentum back on, is how David Solomon characterized it. Though he did talk about the massive amount of stimulus and the impact that that has had, said that we are in a period where greed is outpacing fear. And those periods are not long-lived. Something will kick that rebalance in. Also talked about talent competition as well. Interesting fact he spit out there that over 50% of Goldman employees are under 20. Well, that was the panel. Francine Lacroix will be joining us again very shortly. I'm Danny Berger in London, and this is Bloomberg Surveillance Early Edition. Here's what's coming up on today's program. We are going to be talking back to Francine again. We have lots of market conversations coming up. So with that in mind, let's go ahead and check what is happening in these markets. We have a Bloomberg dollar spot, which is slightly weaker, and I say slightly, not even 0.1%, after a dollar touched another one-year high yesterday following that strong retail data. We also have a pound stronger this morning. Again, we had more data coming out. CPI, the strongest in a decade, looking at a pound that is up versus the dollar, 0.1%. Bond yields ever so slightly higher. The bias for yields had been higher yesterday. I should say lower today for bond yields. The bias had been higher yesterday, again, after that retail data as well. And then we're looking at gold up 0.5%. How much of that is inflationary fears weighing in? Well, here's your look at map markets go. Your look throughout Europe, a little bit of unevenness. Of course, the biggest loser there is the FTSE 100, down 0.2%. That probably is a little bit of the FX effect there, the stronger pound weighing on those multinational, international companies. Elsewhere, we're seeing gains in the FTSE MIB of about 0.3%. That appears to be the outperformer, while we're looking at a little changed CAC 40, and elsewhere on the continent, slightly unchanged, perhaps a bias a little bit higher. So there you go. European equities a little bit mixed this morning after the U.S. was bolstered by robust economic data. Federal Reserve Bank of St. Louis President James Bullard said the central bank should speed up its reduction of monetary stimulus.
The inflation rate is quite high. The core PCE inflation rate, the committee's favorite measure, is about 3.6%. That's the highest it's been in 30 years. So I think it behooves the committee to tack in a more hawkish direction. We could move faster. We kept optionality on this, that we could speed up the taper if it's appropriate.
Joining us now is Thanos Vamvaskidis, Global Head of G10 Forex Strategy at Bank of America Merrill Lynch. Thanos, thanks so much for joining us. Great to have you in the studio. So the retail sales number yesterday, able to thrust the dollar higher, a little bit of weakness today, but the dollar finally breaking out of what has been a month-long slump. What's your base case for the greenback? Are we going to see a winter surge on its way?
There is definitely more strength to the dollar. The U.S. economy is clearly overheating. The data across the board has been very strong, and inflation has been consistently higher than expected. Now, we're seeing inflation pressures almost everywhere in the world. Some of it might be transitory, but in the US in particular, we're very concerned that we have permanent price pressures, which the Fed needs to address. Fiscal policy, in the meantime, in the US is extremely loose, which again points to the need to tighten monetary policy more, earlier, faster.
So if that is the environment we find ourselves in the U.S., and that lends itself to a stronger dollar, what becomes the biggest casualty in terms of pairs? And what comes to mind for me, of course, is the yen with this yield differential. Is that where we'll see the most pain, or where, again, will be hurt the most from King dollar?
A lot will depend on how the Fed will manage a change in its communication and a change in its actual policies. Is it going to be risk-on or risk-off? In a risk-on kind of environment, yen, Swissie should be the currencies to weaken the most, given that we don't expect any monetary policy normalization there. However, if we get more market volatility, I mean, dollar, yen, dollar, Swissie will still do well, but emerging markets will be affected much more, or high beta currencies. It will be very challenging for the Fed to manage this shift in its policies.
Well, speaking of volatility, we have started to see some FX volatility peak higher. It certainly is not where rate volatility is, for example, if you look at the MOVE index. Should we expect that FX volatility goes the way of rates volatility, that it plays catch up?
Definitely, FX volatility has been more limited, but I think to a large extent this has to do with the fact that positioning in rates was very stretched. Positioning FX was very light. However, looking forward, we do believe that we're going to see more FX volatility, not only because of diverging monetary policies, but also when the Fed has to focus on inflation, they cannot focus on equities. So the so-called Fed policy put will be much weaker. This should lead to more market volatility, including in FX.
Right, certainly, and it would definitely be a change of what we've seen over the past year or so. Thanos, you're going to stick around with us. We have much more to discuss. That's, of course, Thanos Vamvaskidis. Now, coming up, UK inflation jumps to a 10-year high. We're going to take a look at the factors pushing up prices and what that means for the BOE. Francine Lacqua is also going to be back from her conversation with David Solomon in Singapore. She will be picking up shortly. She has plenty of guests to bring you from the Bloomberg New Economy Forum. That's next. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in Singapore. Now, the focus, of course, is not only on inflation, but it's inflation in the UK. It's climbed faster than expected to the highest in a decade, tightening a squeeze on living standards. And of course, that's one of the things that we're looking at, living standards, especially for households. Now, that's also putting pressure on the Bank of England to raise interest rates. So let's have a look at what that means for the future and, of course, for BOE moving. Let's bring in Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, good morning, good afternoon for those of us watching from Asia. Surely the BOE has to hike rates in December after the CPI print.
Exactly, Francine. Markets will be asking what more the Bank of England needs to persuade it to go in December. CPI came in at 4.2% in October. That's above the economists' expectations. It's the third straight month that it's above the Bank of England's 2% target. It's the highest in 10 years, and it's only expected to keep on rising. Already this week, we've had the Governor of the Bank of England, Andrew Bailey, saying that he's very uneasy about the inflation picture in the UK. He's explained that the reason he didn't vote for a November rate hike was he wanted to see how the jobs market fared post-furlough. Well, we had the labour market data yesterday, and if anything, they strengthened the case for a December rate hike. So the jobs numbers in December should rubber stamp this argument for a December rate hike. And the fear now will be that worries about inflation mean price growth starts fueling itself.
So, Lizzie, what's actually driving the price surge?
Well, natural gas and electricity prices rose last month after the regulator allowed suppliers to hike tariffs to offset the wholesale cost rise. That's expected to happen again in April at the same time as a planned tax rise. So unless the Bank of England steps in soon, this pressure on household finances could undermine the recovery.
Lizzie, thanks so much. Our Lizzie Burden there from Bloomberg UK economy reporter. Now let's get more on pound calls. I was just looking actually at sterling and what it was doing on my Bloomberg terminal. This is the power of the Bloomberg terminal. When you're outside, you can have it at your fingertips wherever you are. We're back with Thanos Vamvakidis, global head of G10 foreign exchange strategy at Bank of America. So thank you so much, Thanos, for joining us. When you look at the pound, I don't know whether there was a big Bank of England mistake with them talking up the rate increase chances and then not delivering, and whether that puts more pressure actually for December.
I mean, definitely given the latest inflation data, we believe the Bank of England has to hike in December. But more importantly, they have to get their communication straight. I mean, they've been confusing markets with all this back and forth. Clearly, based on the data, their policies are very loose, so they have to move towards normalization. They have to stop adding fuel to the fire in a way. But it is important to also note that high inflation in the UK has reasons that go beyond the control of the Bank of England. The energy prices, where we believe we have not seen the worst yet, labour market imbalances, that is more the job of the government to address. Now, the pound is somewhere in the middle. If the Bank of England indeed starts hiking, the pound should be stronger, but it is also affected by all this renewed Brexit uncertainty, the negotiations with the EU, which has created a completely different driving theme for sterling.
But Thanos, so how much courage does the Bank of England actually need to hike rates in December? Does it make a difference if they wait a couple of months?
I think most likely they will have to hike at this point. I think if they are to wait, given the latest data, it will create even more uncertainty. The Fed is also likely to start preparing the markets for earlier hikes, although next year, not this year. But in the case of the Bank of England, they've consistently been more balanced in their communication this year. Only recently they've created all this confusion with the back and forth. But there's now clear evidence that they have to start moving. Better to start now and then see how things are going next year, to what extent inflation, some of the inflation might be transitory or not. But if they wait, there is a risk that they may need to move faster down the road and create even a more severe market shock.
Thanos, thank you so much. Thanos Vamvakidis there of Bank of America Merrill Lynch. Now, we'll have plenty more, of course, from the Bloomberg New Economy Forum here in Singapore. Up next, we speak to Lynn Forster, the Rothschild, lady of the Rothschild. She's the founder of Inclusive Capital Partners, an investment manager that seeks to improve the ESG performance amongst the companies it invests in. So that conversation is up shortly. This is Bloomberg.
When you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore for the Bloomberg New Economy Forum. Now we're joined by Lynn Forrester, the Rothschild, Lady of the Rothschild, who's a founding and managing partner at Inclusive Capital Partners. Now it's an investment manager for the $1.5 billion Spring Fund, a fund that seeks to improve environmental and societal performance, of course, of its investments through governance. Well, she joins me now. Thank you so much for joining us.
Oh, I'm happy to be here.
It's so exciting. I remember actually having one of the first interviews on Inclusive Capital. This must have been 9 years ago. And now look at it and look at how much more we're talking about ESG. What do you need now to make sure that companies invest in the right way and don't just talk the talk?
Yeah, you're so right. You're so right. But remember, 9 years ago, ESG was not even a term.
Yeah.
It wasn't a thing at all. Yeah. And so sometimes I look at progress and I think, oh my goodness, there's too much virtue signaling. There's too much greenwashing. But then I think of the days when people didn't even think about inclusive capitalism and sustainability was something for the NGOs. So I feel right now, post-Glasgow, that we have a lot to be thankful for, but that we also have a lot to do. I mean, Glasgow was necessary, but not sufficient to solving the climate crisis. One of the great things about this conference is climate is discussed from every single angle. From what should businesses do, what should governments do, what should philanthropies do. And it's going to take a coherent, big effort to move, no pun intended, the oil tanker.
But Lynn, are we going too slowly? This is, the problem is that we have done a lot, right, since 9 years ago, since 10 years ago. But if we're going to hit that 1.5 target, we need a common language. We need a price for carbon. So what are you pushing for some of the companies that you're invested in?
Yeah, that's a great question. And as optimistic as I want to be about Glasgow, I mean, we now know that if everything happens out of Glasgow, the experts are saying we're looking at a 2.4. So is 1.5 alive?
Yeah.
Not without more work. I believe the most important lever that can be put into place is a price on carbon.
Yeah.
That if a price on carbon is there.
Why don't we have it yet?
It's insane. It's politics. And that's such a shame, which is why I'm really calling on as many people of influence as possible to go to the Senate. Right now, in the Senate, the Wyden Amendment is being proposed, which would put a $45 price on carbon. And some might say that's not enough, but it's a start. He's one vote away. All we need is one vote, and that's Senator Manchin. And a price on carbon can also be progressive.
Yeah.
because we should have a carbon dividend for working and middle-class people, because the burden of this should go on the wealthy. So instead of a wealth tax, let's talk about a carbon tax.
Yeah.
And I think that could be acceptable.
So Lynn, that's really interesting. First of all, you think that's acceptable? Because I know you did a fantastic panel where we also had, the president of the AIIB who was saying, look at the Gilets jaunes in France when President Macron tried to do, a lot more. Do you think the tide has turned and actually taxing fuel and taxing some of the fossil fuels in general has just become much more mainstream?
I think it's much more mainstream, but the narrative has to be handled very carefully. People have to, first of all, understand that they will get checks in the mail to make up for the increase in costs. There will be increased costs, but it should not be borne by the working and middle class. I think that's really important. And then the narrative has to be that by doing this, we are turbocharging the possibility for innovation. Yeah. We're going to pay for carbon capture at that point. We're going to go into green hydrogen and blue hydrogen and biomass and all of those things that we might say it would be great for trillions of dollars to be invested in it, but right now they're not economic. So the market doesn't work that way. It'll work that way somewhat, and there'll be people who are willing to invest in wind and solar, even though the returns are slight. But the massive force of the capital markets cannot work unless there's a price lever.
But so you think actually let's get a price at any cost, even if it's a lower price, because at least we have something and then it readjusts.
Yes, I definitely believe that. And that's what Canada is doing. 72 nations and the state of California, New York, they have prices on carbon. And in 2007, John McCain proposed a cap and trade for America. So this is trickled in, but then it goes away. And I mean, I really call on President Biden to do more of this, to do more, be bold.
And then, on talking about boldness, one of the concerns, for example, if the infrastructure goes ahead, the plan, there's no difference between blue hydrogen or brown hydrogen. Like, why are we not aggressive enough in the U.S. about what can be achieved and actually, in defining what's acceptable and not in 2021?
Well, I think part of it is the cost, because for blue hydrogen or green hydrogen to remove, for blue hydrogen to remove the hydrocarbons costs a lot, and green hydrogen takes a ton of energy. So they're both too expensive, which is why if fossil fuels actually paid what they cost to the planet, then you could have an alternative that is clean. And I'm more convinced than ever that a price on carbon is the only way to go if we're really serious. If we're happy with 2.4 and we kind of want to wing it and see what happens,
2.4 is not good enough. If there's anything below 2 degrees, would that be acceptable? Is it something that you think would put us at least on a better path than we are now?
I think the science says, and Paris did say below 2, we picked up 1.5. And I loved the British slogan, keep 1.5 alive. I thought that was great. But I don't think Glasgow achieved that. But I do feel like even without a price on carbon, which is the big solution, there's enough pressure on companies to do something that we're gonna be better off.
Okay,
but I don't know how much better.
Always the optimist. Thank you so much, Lady Lynn Forrester, the Rothschild founding and managing partner, of course, and Inclusive Capital Partners. Now, we'll have plenty more coming up from Singapore and from the Bloomberg New Economy Forum. We'll hear from our conversation with David Solomon. We'll also be speaking to PIMCO's John Stadinsky. The conversation here, of course, on U.S.-China relations. We had a good conversation, a robust conversation with David Solomon, also discussing whether he had any pressure from Wall Street or from Washington, pressuring Wall Street not to become bigger in China. He says no. So we'll discuss that. We'll see what he's expecting as possible big shocks ahead for the markets. This is Bloomberg.
esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá nos reunimos con los oficiales de inteligencia de la policía, nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Well, it's
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore for the Bloomberg New Economy Forum with some great market guests. So we'll talk to, of course, some market participants. We'll talk about inflation shortly. Now to the markets and European equities. A little bit mixed this morning. UK inflation actually rising to the highest level in a decade. That's after U.S. equities bolstered by robust economic data, which may pressure the U.S. central bank into action. Now, we also heard from the Federal Reserve Bank of St. Louis President James Bullard saying that the central bank should speed up its reduction of monetary stimulus.
The inflation rate is quite high. The core PCE inflation rate, the committee's favorite measure, is about 3.6%. That's the highest it's been in 30 years. So I think it behooves the committee to tack in a more hawkish direction. We could move faster. We kept optionality on this, that we could speed up the taper if it's appropriate.
Well, I'm very pleased to be joined here in Singapore by the Vice Chairman, and of course he's much more than the Vice Chairman. He's also Managing Director of PIMCO, John Studinsky. What a treat, John Studinsky. I show up in Singapore. We both live in London, but I get to speak to you here, not in London. So thank you so much for coming on.
Well, here we are in the Garden of Eden.
There you go. A good conversation on inflation. Are we underestimating the potency of inflation to be sticky and remain for longer?
Well, we're no longer using the word transitory, but I think that's been put to rest, I think, in the last couple of days. Inflation's going to be remain elevated for the foreseeable future. How long that is, we don't know, but, it could be a couple of years.
I know, but this is a nightmare for central banks. So if it's not transitory, at some point they were trying to figure out, transitory could mean actually 6 months, 8 months, even a little bit longer. Do you think they'll have to act sooner than they want to?
Well, certainly there are at least 10 or 12 central banks around the world that probably are watching this much more closely. If you look at the Fed's nuances from their last minutes, probably suggests that they're going to raise rates certainly twice in 2022, but maybe it'll be earlier. I mean, there are some people talking about higher inflation than what we've seen in the last quarter and the next quarter in the United States, so we'll have to wait and see. You saw the inflation data coming out earlier today for the UK.
Blowout.
I think that probably means that's going to rattle Andrew Bailey's cage a bit at the Bank of England, and maybe he's going to have to look again in December about the rate decision.
I mean, what does it mean for fixed income in general? Are we going to see a big repricing, or has a lot of this stuff already been priced in, especially after, the Bank of England disappointed a lot of the markets last month?
I think markets have pretty much priced in a lot of these. I think what's really going to be interesting is to see, this is uncharted waters. We've got a lot of things, Francine, and you're hearing these discussions at this conference about the whole question of inflation and the variables affecting inflation. We're talking about a lot of investment in green. We're talking about deglobalization. We're talking about supply chains with China being disrupted and how that affects prices elsewhere in the world. And, of course, we look out the window here in Singapore and we see a lot of ships in the harbor. Very fewer queuing there than in Los Angeles or in Shanghai, but it's a big issue.
Do you still expect a lot of these, energy shocks to go elsewhere? So these supply chain issues to remain with us for longer? And what does that mean for the economy going forward?
Well, you've got an overlay now on energy shocks, certainly in Europe. You have Mr. Putin and the whole issue with Poland and Belarus, and he's going to use his role as sort of the key czar of Europe's energy security to play he has a big seat at the table, and that's going to affect a lot of uncertainty on energy pricing, certainly in Europe.
What do you worry about the most, John? I know you speak to, all chief executives, many people from many walks of life. You're also an expert on China. Are we misreading the U.S.-China tensions and how they could develop going forward?
I think the most important thing about the dynamic on China is America has a strong view about China, and there's a strong domestic voice about issues it has with China. China has a view about America, and there's a strong Chinese voice in America. In China about America. I think they need to both take a little more time to better understand each other. There's some disconnects right now. I think Biden is trying to engage more, but there's still some disconnects.
Where are the main disconnects, and actually what can be done? So if you have a disconnect at the government level, does it still mean that companies work with each other on a corporate level, so on a private level between U.S. and China, for example, on green technology and things like that?
Well, China has been very much ahead of the curve, as we all know, on green technology. I mean, 77% of the world's batteries, particularly relating to green applications, are manufactured in China. So I think there's probably, if I had to wave my arms and say, what would I really like to see? I'd like to see more integration between Chinese and American manufacturers relating to solving green energy problems, because each one of them has certain segments of products and services. If they were more integrated and more collaborative, I think you would accelerate the way that some of these solutions were actually achieved. And I think we're beginning to see that dialogue here. I think you're going to see more of that in the next 6 to 12 months.
So this is not like a supremacy, this is not a battle for ultimate supremacy that we're seeing between the two countries.
Well, I think there's a lot, we talk about the Industrial Revolution and what happened in Europe and America in the Industrial Revolution. 1% inspiration, 99% perspiration. The Green Revolution is going to take decades to really come into full swing. I think we've been spoiled by the fact that COVID being the first sustainability shock, we had a vaccine in 12 to 15 months. We had a number of vaccines. We now think that we're going to come up with really credible technologies efficiently, expeditiously for climate. We are, but it's going to take years. And we just have to pace this over the next 5, 10, 15, 20 years. And the transition from brown to green is serious, but it has to be done as a transition and not absolutely cutting off one and embracing the other, particularly if the second one isn't really well developed.
What are you most concerned about that we're underestimating? So we talk about inflation, we talk about the energy costs, we talk about geopolitics. And I know it's very difficult to predict a black swan event, but what's on your mind that we should talk a lot more about?
I think we probably are underplaying the role that the digital revolution is going to have on human behavior. And whether it's artificial intelligence in medicine, whether it's decision-making in the investment field, how that's going to have an impact on the world. I think it's artificial intelligence, virtual reality. It's going to change a lot in the next 2 to 3 years, probably more than we realize. And it's also going to have a big impact on education.
John, thanks so much, as always, for a little bit of your time. John Studinsky there, Vice Chairman and Managing Director of PIMCO, joining us from Singapore at the Bloomberg New Economy Forum. Now, coming up in the next 4 days, we understand, Joe Biden will confirm the next Fed chair between incumbent Jay Powell and Lionel Brainard. Up next, we're joined by economist Randy Krosner. This is Bloomberg.
you should be thinking about formerly incarcerated people as representative of their families also and of their communities. These are human beings. They're not disposable items. They are not to be warehoused, locked away, out of sight, out of mind. And so I'm out here in the public because I am the conscience of those folks of America, I hope. I'm hoping to prick their conscience and know that I am just a symbol of a much greater problem.
You finally got your taste of MIT, so why did you decide to leave MIT and come in and run the SEC?
One, when a president asks you to do something, it's really hard to say no. But it's also just an incredible privilege and an honor to serve.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore. Now, we talk about the markets, we talk about the Fed. We understand Joe Biden will announce his Fed chair nominee in the next 4 days. The top job will go to either current chair Jay Powell or Fed Governor Lael Brainard, while Senate Banking Committee Chairman Sherrod Brown said he has no doubt that the Senate would confirm either candidate. Now, the first step in the confirmation process would be actually approval from the Banking Committee. So joining us now to talk about all of this is Randy Krosner. No one knows the institution better. He's a former Federal Reserve Governor and Deputy Dean for Executive Programs at the Booth School of Business, University of Chicago, based in London. Randy, always a pleasure. I can't believe we're so far apart. Always a pleasure to speak to you. First of all, does it really matter to the markets, Lael Brainard or Jay Powell? How much would they differ in terms of dovishness?
I think in terms of monetary policy, there's a lot of similarity between them. I think they've been pretty much aligned. Probably Lael would be a little bit slower to raise rates, but only a slight difference. I think they'd be very similar in terms of policy.
So, Randy, how are you thinking of this, actually? I don't know whether, it's almost a given that President Biden will choose a Democrat. Why would he not? Why would he not choose a woman? Or do you think it's all to play?
Well, it's very clear that Janet Yellen, who I think has a very important voice in this decision, is very supportive of Jay. They work very closely together. I think Jay is really pursuing the same kinds of policies that Janet had pursued. So I think it's a real debate within the administration. Should they go for Lael or should they go for Jay? It's not really in terms of policy because they're very similar in policy, at least for monetary policy. Some of the other areas like crypto and regulation, there are some big differences.
Yeah, so let's say we have Lael Brainard actually as a new Fed chair. What will she most make a difference in? So crypto, but also maybe banking?
Yeah, so I think it's very clear that she has a different view than Jay and Randy Quarles, the current vice chair for regulation of banking and financial regulation. She dissented, I think, more than 20 times on a variety of the votes that the Federal Reserve Board had on regulation, always wanted to preserve tougher regulation. So my guess is she'd be tougher on banks than they have. Not that they have been light on banks, but I think she'd want to be more aggressive. Also, I think there's a big difference on crypto. Jay has said he's still trying to decide which way he wants to go. Lael has said, full steam ahead, we've got to have a central bank digital currency now.
Randy, when it comes to banking regulation, what kind of support would actually, a possible chair Brainard get? And, what do you think would be the easiest thing to change if she were to take over?
Well, I think one of the things that she has been vocal about in the past and the Fed did not do were these so-called countercyclical capital requirements. So that during good times, like, as the economy is coming back fairly strongly now, to get banks to hold a little bit more capital, so that if times turn not so good, you can draw on that. And that was something that she had pushed for. The Fed didn't do it, and I think that's something that probably would happen if she were either the vice chair for regulation or certainly the chair.
Randy, what's your take on inflation? Inflation, doesn't look like it's transitory, but it could be with us only for about 12 to 18 months. Is that transitory? Are central banks fine to wait? Or are they doing the right call?
We're starting to split hairs over exactly what transitory means versus other sorts of things. So I think we do need to put transitory into the dustbin of history, although they kept it in the statement. I thought surely they would move beyond that. Transitory is, I think short-term is better because I think we're looking at least 6 months to a year of much higher rates. And part of that is a bounce back from the depths of lockdown a little bit more than a year ago. Part of it is just pent-up demand coming in and interacting with the supply chain issues. But the key question is, will this short-term issue turn into a longer-term issue? Will inflation expectations start to move up? And that's a big question mark because we don't really understand the inflation expectations process that well.
Yeah, why don't we? I was going to ask you, why is it so difficult actually to read inflation? We have, we should have the brightest minds and the brightest economists to tell us, or at least model something that could come close to what we should be seeing.
Well, I think we certainly do, but the question is, if you don't have the data, doesn't matter how smart you are, it's very hard to understand exactly what's going to happen. And so we haven't been in a position like this before. Remember, we've had very low inflation for more than 2 decades, really no threat of high inflation, and the Fed has been undershooting its 2% target ever since it articulated it almost a decade ago. Now we're 4%, 5% inflation. This is happening not only in the U.S., but globally. And we haven't done enough in terms of research to really look at the behavioral aspects. What do people think about inflation? How much are they paying attention to the Fed's new framework? What causes them to unanchor their expectations or anchor their expectations? I mean, you're in Asia right now. We have a lot of questions about what happened in Japan. Why can't Japan get to 2%? Inflation expectations have stayed low despite incredible work by Kuroda-san as the head of the central bank, building the central bank's balance sheet to more than 100% of GDP and still going further. And they haven't been able to be successful. We need to do more research on that.
So, yeah, we do. Randy, what's the biggest policy mistake right now, given the parameters that we have at our disposal, which, as you say, we need to study a couple of things more. But is it a mistake to, take it slow, or would a mistake be to have to raise rates now and then take them back down in 18 months?
Well, I think some sort of shock now would not make sense because we still have a lot of uncertainty about the virus. I mean, we don't know what's going to happen this winter. Hopefully, we will not see a resurgence of the virus, but there's still uncertainty around that. So I wouldn't want to go too quickly to claim that we have complete victory over the virus. That hopefully will come by early next year, and then I think we can start to move a little bit more expeditiously. But even though the supply chain shocks are outside of the Fed's remit, they can't do anything about producing more chips. But they need to be mindful that the supply chain shocks that are causing prices to go higher could change expectations. So I think they may need to move a little more rapidly, starting in the end of the first quarter of next year.
Randy, thanks so much. Randy Krosner, their former Federal Reserve Governor and Deputy Dean, of course, in London at the Booth School of Business, University of Chicago. Now, we'll have plenty more, of course, from Singapore and from the Bloomberg New Economy Forum. Coming up, we hear more from my panel with the Goldman Sachs Chief Executive, David Solomon. That's coming up shortly, and this is Bloomberg.
the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector in Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think that we're turning the economic environment back on, but because of this crisis, we've had a massive amount of monetary and fiscal policy all over the world that's having an impact. It's having an impact on asset prices. It's having an impact on inflation, as you mentioned. I think markets generally, when I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. And generally speaking, my experience says that, those periods are not long-lived. Something will rebalance it and bring a little bit more perspective. Certainly, given that it feels like inflation's rubbing above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
But are you expecting some kind of taper tantrum from the markets?
I'm not a good predictor. I've never thought of myself as a good predictor, but I certainly feel like the market anticipates higher rates at this point in time. The question is how much, how quickly. I don't think there's a chance that central banks can unwind this massive stimulus in a way that doesn't create some sort of a taper tantrum or some sort of a real shock to markets. But there's also a chance it can't be done that way. And I do think that people, it's been a long time since we operated in an environment where the general trend on interest rates has been higher and the general trend on inflation has been above trend. I got out of school in the early 1980s, and generally we've had the opposite, for that 35 plus years. And so, I do think people don't remember when Paul Volcker raised interest rates by 300 basis points on a Sunday afternoon. So there are a lot of factors that will go into, how this process plays out. It's unclear, but I certainly think that thoughtful market participants are thinking about it. In my conversations with big institutions, they're thinking about it and they're trying to balance the need to participate and have relative performance based on participation, and what happens as we unwind some of this and we rebalance a little bit.
So are you telling me that you're worried that, markets are too cool about it just because they've made money for the last 10 years?
Well, I do think that, generally speaking, everyone feels quite smart right now because most of the things that you invest in are going up. That's not the way it normally works. So again, I'm not a great predictor, but my experience tells me this is a moment in time that's probably not a sustainable moment in time.
But then it would be what, an economic shock? So away from an inflation monetary policy, what could it be?
It could be a change in the perspective of the course of economic activity. It could be some sort of a geopolitical shock. It could be that something goes wrong with respect to our emergence from the pandemic and we have a different set of events that change the perspective. But all of this is based on kind of confidence and a forward view. And, I would say at the moment, the forward view is quite optimistic. If it stays optimistic and, central bankers, handle the withdrawal in an appropriate way with the right communication, there's a chance we can do it, in a balanced way. There's a chance something could go wrong. Got to be prepared for both.
How do you prepare, actually, for both?
Well, you prepare by, thinking about if the world looked differently, how it would affect different assets, and, how would you feel if things were worth less? Yeah. Not worthless, but worth less. So in that context, we do a lot of, we talk to our clients a lot about different scenarios, and, we think a lot about our own balance sheet and, our own propensity for risk as we try to navigate those things.
Talk to me a little bit about China. So you're optimistic longer term in China. Do you ever get any pressure from Washington to grow less fast in China?
We're very committed to building our business in China, but in the context of the fact that Goldman Sachs operates, globally all over the world, and we serve governments and institutions and corporations all over the world. And given the importance that the important position that China plays economically in the world, you really can't be Goldman Sachs without participating in that. I wouldn't say there's direct pressure on us to change our long-term plans to grow our business in China. Is it possible at some point in time something goes on geopolitically between the U.S. and China, and because we're a U.S. company, there's either pressure or directive for us to do certain things differently? Sure, that's a possibility. But we think about this with a 10, 20, 30-year perspective, not with a next couple of year perspective. And so we're long-term committed to continuing to serve our clients by having the resources and the capabilities in China that allow our clients globally, to participate in markets.
Well, that was Goldman Sachs Chief Executive David Solomon speaking to me a little bit earlier here at the New Economy Forum. We went also on to talk about his license in China and some of the pitfalls out there. Now, stay tuned to Singapore. We'll have more interviews tomorrow, including our guests, the Chief Executives of HSBC, Bayer and Moy Hennessy. It's interesting to have all of these different players and newsmakers from all walks of life to really try and understand some of the supply chain issues, some of the energy shocks, how they affect their business. Bloomberg Surveillance, early edition continues in the next hour. This is Bloomberg.
Years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels.
There are dozens of international companies in that airframe size who've realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
inflection
just
point.
finishing what you were saying, Tom.
Thank
November
you.
3rd is
You did
when the
good.
decision is.
Extend
Just in
this,
case
Jen,
people
please.
got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what the data are telling us is that after the Delta variant setback, the economy is getting back on track.
I think there are a lot of uncertainties across different axes of the market debate.
The market's underestimating the extent of fiscal drag that we're going to face next year.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, November the 17th. Our top stories today. Who will be the next chair of the Federal Reserve? President Biden narrows the field to just 2 contenders and says we'll learn his choice in a few days. The Bloomberg New Economy Forum kicks off in Singapore with some of the biggest names in finance and politics. There's one overarching question. What does a workable relationship between the US and China really look like? And pressure builds on the Bank of England. Inflation in the UK rose faster than expected to the highest level in a decade. Investors wait to see if the central bank raises interest rates. I'm Anna Edwards with Tom McKenzie here in London. Matt Miller with us in New York. Kaylee Lines is off this week. And Matt, we have a few days then perhaps to wait to hear who's going to lead the Fed. In the meantime, plenty of big voices in finance talking to us from Singapore through the Asia session.
That's right. And on Bloomberg television yesterday, we had the most dovish and the most hawkish members of the Fed talking to us, Neil Kashkari and Jim Bullard. So we got kind of bookends there. Let's take a look at what's going on in Asia. Speaking of Singapore, we have the Msci Asia Pacific Index down 0.5% right now. There are real concerns about exports. In a second, I'm going to show you something out of Japan, but here is the benchmark in Tokyo. The Nikkei 225 down 0.4%. The Kospi moving down even further. I noticed real volatility over the past couple of days in the Kospi, so big moves away from its average over the past 30 days over the last 3 or 4 trading sessions. Here's the U.S. dollar, Japanese yen. Little changed right now, but as you can see, we're getting closer and closer to 115. So this is, I think, a 4-year low here for the yen, and it could get even cheaper. That's not bad news for the Japanese. If you look at the exports out of Japan, they have drastically slowed, or at least export growth has drastically slowed. And this is one of the issues that's been weighing on Asian stocks. They have real supply constraints, and that is holding back the amount of stuff they can sell. Actually, in that case, maybe a cheaper currency doesn't even really help, because the problem is actually getting it made and on a boat and out of the port. By the way, take a look at U.S. stocks right now, or at least U.S. futures, also down, but really little changed on well, not having those concerns. The concerns for the U.S. market would be rising interest rates because of rising inflation. A lot of people were listening to James Bullard yesterday, but of course he is the most hawkish member of the Fed, so that's obviously going to be his point. The U.S. 10-year yield right now down a little bit as investors buy that debt, 163.19. So we've seen it rise really substantially over the past few sessions. Speaking of substantial gains, gold right now up 0.5%, and it's really on a march to 1900, 1859 a troy ounce. Bitcoin going the other direction, down at 59,062. Tom, what are you saying?
Yeah, Matt, of course, we've referenced the red-hot debate around inflation in the US. We have inflationary data out of Europe as well for the Eurozone. So harmonized October data. Month on month, it was in line with the estimates. 0.8% was the increase. Year on year, just slightly softer, 2% versus 2.1%. We know that Christine Lagarde of the ECB has suggested there is no chance of a rate hike next year, 2022. But the When you unpack this data, the questions will be, of course, to what extent energy prices will remain elevated and whether that sustains these prices going forward towards the end of the year and then into 2022. Let's check in on how the markets are digesting this. We had inflation data out of the UK as well at a 10-year high, 4.2%, well above the estimates. It is putting into play very much now the idea that the Bank of England will raise rates in December. There's the consensus conforming around that view now. In the FTSE 100, seeing losses of close to 0.4%. It's flat in France on the CAC 40, gains of 0.2%, close to 0.2 on the DAX over in Germany. And the FTSE Mid in Italy is up by close to 0.2% as well. Losses over in Spain of 0.2. So a divergent picture across the map here in Europe as investors weigh up this inflationary data. Let's have a look at some of the cross assets that you're talking about. Gold, again, heading towards that 1900 level, as you mentioned, Matt. There is that support for the yellow metal. That is a view from some, gains of 0.5%, as you noted. Across the benchmark, gains of 0.1%, continuing to build on these record highs in Europe. The pound is in focus on the back of the inflationary data. It popped earlier in the session. It's currently a little softer at 134. And crude as well, lower, below $80 a barrel on reports that maybe you're going to get a coordinated effort between the US and China on releasing reserves. Pressure in the oil space down 1%.
Let me talk to you about another inflation theme, or fights against inflation, what you do and don't do in that situation then, Tom, but with the Turkish situation in mind, because we're getting some lines just in the last few minutes from the Turkish President Recep Tayyip Erdogan. He's vowing to fight against interest rates. He says he won't allow people, Turkish people, to be crushed under interest rates. I guess you might file this under things you already knew as well, because we have known for some time that the Turkish president has not been a fan of of using interest rates to fight inflation. And hence we've seen substantial movement in recent years on the Turkish currency. It is currently 10.4 to the dollar. Just 5 years or so ago, I think it was around 3. So a substantial movement in recent years. Now let's take a look at some of the other things we're watching out for today. The EU will unveil its strategy for more than 46 billion euros in technology and infrastructure spending. This is a key part of the West's response to China's Belt and Road program. Follows on from, of course, that meeting between the US and Chinese leadership. The SEC chair, Gary Gensler, and Fed presidents from New York and San Francisco will speak at the US Treasury Market Annual Conference. I wonder if crypto will get a mention. It's certainly been mentioned in Singapore at our conference there. Now, the UK Prime Minister Boris Johnson faces a grilling from the Commons Liaison Committee, a senior panel of all all the select committee chairs, so essentially some fairly powerful people from different parties across Westminster, and the recent scandals in the UK around the behaviour of MPs will be in focus. And we will get more from US data, including housing starts and MBA mortgage applications. Of course, it was, Matt, some strong data that allowed further risk rallies in the US yesterday. That retail sales number better than had been expected.
Yeah, absolutely. Americans seem to be flush with cash and are spending it when they can find stuff to buy. Now, President Biden is still deciding whether to reappoint Fed Chair Jerome Powell or replace him with Fed Governor Lyle Brainerd. The president says to expect an announcement within about 4 days. St. Louis Fed President James Bullard told Bloomberg yesterday he expects continuity amid the leadership reshuffle.
No matter how this comes out, there'd be a lot of continuity in Fed policy. Both of these players have, long track records at the Fed. So certainly it's a big committee. Also, I think people have to keep that in mind. And there's a lot of experience on the committee. So I think we'd see continuity.
Anne-Marie Hordern joins us from Washington, D.C. And Anne-Marie, I guess, depending on your perspective, 4 days is about as imminent as 4 hours, right?
Yeah, we went from imminent to a bit of indecisiveness from the White House, given the fact that the president has yet to even make a decision. But we do know that it is between these two contenders. It is certainly going to be either a reappointment of current chair Jay Powell, or Governor Brainerd is going to get a more elevated position at the Fed. And what we do know is that there are also some senators now looking to have some meetings with these two individuals, especially with the current chair, Jay Powell. He'll be meeting with Senator Joe Manchin. Remember, this is the senator who in August sent the chair a letter talking about his concerns of higher inflation. And really, monetary policy, everyone says there's going to be this continuation, regardless of who gets this top spot. But whoever does get it, that is going to be the issue they have to deal with, and that's going to be inflation. That has made this decision a little bit more dramatic, those October CPI numbers.
Yeah, absolutely, Anne-Marie. It's interesting to think about what difference who leads the Fed would make, but then also what political messaging might be behind the decision as to who leads the Fed. And what are you hearing about the way that the White House is weighing up the politics of this? Because inflation, not just a monetary policy issue right now, but really at the front and center for politicians.
Well, neither Chair Powell or Governor Brainard have been in their roles where they've had to deal with high inflation. Governor Brainard has been in the role from 2014, and we've had inflation average 1.4%, nothing with a 6% handle. So we don't really know how either of them will really have spoken about inflation because they haven't dealt with it. When you look at the politics behind it, though, she clearly has a little bit more of support with the progressives in the party. Senator Elizabeth Warren has not come out and supported her outright, but she has called Jerome Powell a dangerous man. There's also Senator Sheldon Whitehouse of Rhode Island, who, if it was going to be Jay Powell, he wants to hear him take a little bit more of a tougher stance on climate change. There are issues that they diverge a little bit on, and this could be banking regulation, climate change, cryptocurrencies, whether or not there's going to be a central bank crypto. But when it comes to monetary policy, these two individuals are in lockstep.
Okay, Bloomberg's Anne-Marie Hodon, thank you very much indeed in Washington on the politics of that Fed leadership decision. Okay, now to Singapore, where the 4th annual Bloomberg New Economy Forum is underway. China's growing role on the world stage, climate change and economic questions from inflation to cryptocurrencies have been the focus. Bloomberg's Francine Lacroix has spoken to a variety of guests on supply chains.
We need to think about resilience. We need to think about inventory. Right now, every CFO in the world is out telling their suppliers, you need to have more inventory.
The underlying trend, pre-pandemic and certainly to accelerate, is that the principal powers in the system, the United States, the European Union, and China, really do want to nationalize supply chains, do nearshoring, industrial policy.
All the indications we have is that it will flow right through into beyond the middle of next year. We're a nation way down in the Pacific. We rely on supply chains for everything that we bring in and anything we sell. There's no easy option for us.
For so long in our supply chain, the mantra has been just in time. And now we realize the vulnerabilities of just in time. We need to move to just in case.
Bloomberg's Francine Lacroix is on the ground at the event for us in Singapore. So some voices there on the needs to shore up the supply chain. Hi, Francine. What else has really stood out to you from the conversations that you've had with corporate and world leaders just in the first stages of this conference?
Yeah, I have to say, Dom, first of all, it's a lot about jet lag. I mean, a lot of these executives, it's the first time they travel in about 2 years. I just had this conversation with the Goldman Sachs chief executive. He says he hasn't been in Asia since early 2020. And so he was excited to be here. He did tell me that he wasn't going to be in Hong Kong like Jamie Dimon was just because of the quarantine rules. But, you know, a lot of people, it's the first time that they've been here in the country for a long time, in the region for a time, and it's a time for them to talk to each other. So the focus is definitely on inflation. I hear a lot of inflation. What does it mean for your business? What does it mean if interest rates rise? On financing and, of course, supply chain. But the bigger question is also China. China's role in the world, China's role in climate change, and, of course, Matt, you know, China's role in some of these supply chains, especially if they continue with the zero COVID policy.
And, well, speaking of chains, and you mentioned Jamie Dimon, I wonder what you're hearing about crypto, because you know, we saw this incredible rally in Bitcoin to almost $70,000, and now it's back down with a 50 handle.
Yeah, so if you speak to a lot of the big banking executives, you know, a bit more mainstream than maybe some of the cooler AI guys, for the moment they say, look, crypto is not something I want to be invested in for my bank. We know, though, Matt, that, of course, they're still looking at ways to not disappointing some of their clients that want to be exposed to it. And then you speak to, you know, the younger guys that have come here and actually want to push crypto forward, and they're worried about regulation. So I think it's all about regulation in the next couple of weeks or months. That's what the talk is here. And then, of course, market correction. I asked that to David Solomon. I said, look, given we haven't been able to lose money in the last 10 years, what does it mean when we have a price readjustment because of monetary policy? And he laughed and says it's true that in his career, he's seen moments of greed, usually followed by some kind of setback. And in the moment, he calls it a moment of greed just because it was very difficult to lose money, or not very easy to make money is the way he put it. I put it the other way, Anna.
Francine, thank you very much. Francine Lacroix in Singapore. Our coverage of Bloomberg's New Economy Forum, of course, continues, and we'll be speaking to the Prime Minister of Singapore at around 7 a.m. New York time. Now, here in the UK, inflation has surged to the highest in a decade. This puts increased pressure on the Bank of England to raise interest rates. Let's get more with Bloomberg's UK economy reporter, Lizzie Burden. And Lizzie, the Bank of England then, looking at this data, there'd been a lot of expectation that we were going to see a hike in November. The market was wrong-footed there. Now all of that expectation heaped on December.
Yeah, markets are going to be asking what more the Bank of England needs to persuade it to hike in December. Inflation at CPI came in at 4.2%, so that's above economists' expectations. It's also the third month that it's above the Bank of England's 2% target. It's a 10-year high in the UK, and it's expected to keep on rising. Already this week, we've heard from the Governor of the Bank of England, Andrew Bailey, saying he's very uneasy about this inflation picture in the UK. He said the reason he didn't vote to hike in November was because he wanted to see how the jobs market's doing. Well, the labour market data that we got yesterday added to the picture, to this argument for a December rate hike. And so the question now is whether fears about inflation will mean that price growth starts fueling itself.
Lizzie, we saw that jump in gas prices again yesterday on the back of the news around Nord Stream 2 and the hold-up in terms of certification for that. How central are those energy prices to what's driving up inflation more broadly across the UK?
Very. You had a bigger than expected rise in hotel and restaurant costs, but it all really comes back to energy. Wholesale natural gas and electricity prices rose last month after the regulator allowed suppliers to hike tariffs because of offsetting these wholesale costs. That's expected to happen again in April at the same time as a planned tax rise. So unless the Bank of England steps in soon, this squeeze on household incomes could undermine the recovery.
All right, Lizzie, thanks very much. Lizzie Burden there, Bloomberg's UK economy reporter. Let's take a look now at some of the stocks moving in the pre-market here in the United States of America. Lucid Group is rising, and Lucid is now worth more than Ford and GM. This incredible EV rally that seems to have been sparked by the Rivian IPO has really made Lucid a leader. Every day when I look at the pre-market movers, most space U4 is the way I do that. Lucid seems to be right up at the top this week, so now it continues to gain 7% in the pre-market. Visa, on the other hand, is going down. The payments network getting hit pretty hard by an announcement from Amazon. They will no longer be accepting UK-issued Visa credit cards. In fact, they told consumers in the UK that they would get a £20 gift receipt or £20 gift certificate if they would switch to any other kind of card, including a Visa debit card. And then what I really think is interesting is Qualcomm. They had an investor day yesterday. They were very bullish, saying they could reach $46 billion in sales by 2024. A huge piece of that is augmented reality goggles, I guess you would call them. Qualcomm says that business could become as big or bigger than the phone business, which I struggle to understand, but I'm getting a lot older. Maybe the kids love it, Anna. Maybe the kids love those goggles.
Yes. Very meta, I'm sure. Now, coming up on this program, the ECB warns of market exuberance. We will speak to BlackRock's Elgar Bach about that subject. That conversation coming up shortly. This is Bloomberg.
Hello, traders. I'm placing an order to buy euro. The price I'm looking to buy, 113.11.4. If you're looking to trade euro, please place your order at 113.11.4. Okay. If you want to get the strategy, you need to go to company.co.uk. If you use the strategy, you know what to do. We're still waiting. We didn't fill yet, and hopefully we will fill this order. And I will guide you through these trade until the end. We're still holding several positions on euro. Also, we have short positions, so it will be quite a ride. Okay, guys, stay safe. I'll speak to you later.
As to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards and Tom McKenzie in London. Now, we've noticed an interesting trend over the past couple of weeks that seems to be continuing, and that is one of bond market volatility. We've seen bond market volatility represented by the MOVE index far outperform stock market volatility represented by the VIX index. In fact, the VIX index is relatively low, trading at about 16.5 right now. Meanwhile, the MOVE index is up at 81.5. We're joined by Christine Aquino, who helps lead Bloomberg's market coverage out of London. Christine, why is bond market volatility soaring while the VIX is languishing?
Well, Matt, when you think about it, the bond market has really been at the epicenter of the shift change that we're seeing across monetary policy across the globe, right? That's really where investors were flocking to first when they first heard about the possibility of the Federal Reserve, of the Bank of England, all these other big central banks suddenly thinking about raising rates. But then when you look at the stock market, in some ways, it's still very much a supportive environment, right? We do have signs, even though inflation is roaring, we do have signs of growth still picking up, especially out of the U.S. And then couple that with still, pledges from policymakers, even though they're considering a shift to tighter policy, still some comments from them to say that they're going to keep supporting the markets, at least in the very near term, with bond purchases.
And we have been suggesting, Christine, that the volatility was limited to bond markets, and Matt's making a good point about in relation to stocks. We are starting perhaps to see a little bit of that volatility creep into FX markets. I know our colleague Simon Flynn writing about this.
Absolutely, Anna. That's the next big thing that we're watching out for sure. Because I think you're seeing a lot of gyrations in the FX market starting to react to what we're seeing, again, in response to inflation, in response to the policy changes. The dollar also holding near its highest levels in a while. That's certainly contributing to that rise in volatility.
Okay, and it's not all about the pound, although some of it might be. Bloomberg's Christine Aquino, thank you very much for joining us. And for more market analysis, check out MLIV Go on your terminal. This is Bloomberg.
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like.
We've seen a bit of the price. Directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about
in March of last year to really focus our efforts at Heathrow?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Get your first word news. And Treasury Secretary Janet Yellen is warning Congress that it risks a government default if lawmakers don't raise the debt ceiling by December the 15th. That's the date when the new infrastructure bill requires the Treasury to transfer $118 billion to the Highway Trust Fund. Congressional leaders haven't disclosed how they plan to resolve the issue. Coming up on this program, Elga Barch, head of macro research at BlackRock. We will get her thoughts on whether we're seeing signs of market exuberance. The ECB warning about that today, echoing Greenspan of decades past. This is Bloomberg.
Okay, guys, it moved away, as you can see, and for time being, I will have to cancel the order to buy euro. We will see what's going to happen next. Looks like momentum changes, and we will look into enter new long position on euro. It's just a matter of time when we're going to do this. For our strategy, please go to company.co.uk. Okay, guys, stay safe. I'll speak to you later.
China I've spoken with Xi about Taiwan. We agree, we'll abide by the Taiwan agreement. That's where we are. And we made it clear that I don't think he should be doing anything other than abiding by the agreement.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How are you thinking about those dynamics?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom Mackenzie in London, Matt Miller with us in New York. Kaylee Lines is off this week. And Tom, I'm certainly watching gas prices this week. Just in yesterday's session, we saw European gas prices in the Eurozone and also in the UK jumping by 17%. Today, another day of moves to the upside, up by more than 6% on both of those measures. So we are seeing some moves to the upside. Given our concerns around inflation, that's certainly something we need to watch.
On the flip side of the energy story then, oil prices. WTI now down more than 1.2% is close to the losses you're seeing in today's session, below that $80 a barrel for WTI. Brent is in similar territory as well. Reports that the US and China may be talking about some kind of coordinated effort to release reserves. We'll see what happens, but certainly pressure on the oil space.
Okay, yeah, certainly pressure on the oil space. And Matt, then, just as we approach the US session, what catches your eye, apart from the rise of electric vehicles?
Well, actually, the rise in gold has caught my eye this morning for sure, but also the continued drop in Bitcoin. So we saw, Bitcoin approaching $70,000 a piece, and now it's at $59,000, a drop of just about 10 grand in a couple of weeks. Right now, down 2.5%. We do see the 10-year yield creeping higher. Right now, it's coming down a little bit, but it has crept higher since 24 hours ago. This time yesterday, 162.67. Right now, S&P futures are doing a whole lot of nothing. Right now at 46.94. So we don't expect to see a lot of direction at the open, but you do see a little bit of a gain in Europe, the stock 600 right now. In terms of the pre-market movers, I've been talking about some of these stocks. You mentioned the EVs, right? Lucid is now bigger than Ford and GM. It's up 6.5% in the pre-market at 59, and this has really been sparked by Rivian. So check out RIVN on your terminal if you want. When their IPO hit, it started driving Lucid up, LCID. The CEO, Peter Rawlinson, said he thinks they will be able to produce 20,000 vehicles next year, and that was in doubt, in jeopardy because of the chip shortage and really the supply chain crunch. Visa down now 1.5%. This is more of a UK-specific issue, but Amazon says it won't accept Visa credit cards anymore because of the high fees. Now, this could be the beginning of a war between all credit card issuers and Amazon. They will give users who don't use a Visa credit card, who enter a different form of payment, a 20-pound gift certificate. So you may think about that, Anna and Tom. And then Qualcomm, right now it is down, but it jumped yesterday in the live trade after they gave a very bullish outlook and said they could reach $46 billion in sales in 2024. $3.5 billion in sales to the auto industry alone, and that AR, augmented reality goggles, could become a bigger business than the phone business for them. So really interesting stuff from Qualcomm. Anna?
Yeah, a host of movers then pre-market. Let's think about whether we're seeing exuberance in any of these markets then, Matt, because the ECB has issued a warning about just that, talking about pockets of exuberance. In its financial stability review, the central bank warned that stretched prices in the credit, asset and housing markets pose a threat to euro area stability. Elga Barch, BlackRock head of macro research, joins us now on set here in London. A real pleasure to see you on set this morning with us then, Elga. Let me ask you, do you see pockets of exuberance? That's the wording that the ECB is using this morning. Do you see any of those pockets?
At the macro level, we don't see pockets of exuberance, no. In fact, we remain pro-risk and in particular like equities at this stage. If anything, a concern is the decline in liquidity in government bond markets, and with the difficult decisions that central banks are facing in the light of the spike in commodity prices, that's really where the concern is, and that would be an area, government bonds, that we would be underweight.
That's an area you're underweight, but thinking about your equity exposure then, Elga, how does the inflation concern play into that? You think that actually with rising inflation it's a good place to be in equities rather than being in bonds, or do you have concerns that further down the track the inflation numbers start to eat into the sort of economic recovery stories that we've seen globally?
Not yet, and in fact we do like equities as a place to hide from inflation, so to speak, not in the least because companies are still having a lot of pricing power to pass on the cost pressures that they're facing, and we do think that central banks, even though at some point they might react to the rise in inflation expectations in particular, they will do so in a much more muted fashion than they have done in the past, and with real interest rates staying low, risk assets are well supported.
How much risk do you want to be taking along that spectrum of risk assets within the equity space? Do you like small caps at this stage? How much discrimination do you have to impose on that decision given the pressures that Anna's just been discussing?
Yeah, so we have a differentiated approach, and we do like to seek cyclical exposure where we think it's still attractive. One place would be Europe, another place would be US small caps. So there's definitely sort of some differentiation in the view.
You're also positive on China equities, but also China credit. What underscores that view given the list of concerns emanating out of mainland China?
So the main reason is really that a lot of the bad news on policy tightening along a number of different dimensions is now behind us, and that we are seeing already on the ground some signs of an easing, especially in the property side.
Matt?
Yeah, I was wondering, we all sort of learn in Econ 101 that inflation can be a tax in a sense on the poor.
I do apologise.
Food
I think that
and oil
Elga, I think that I'm sorry, Matt. I don't think that Elga can hear you, so I'll try and jump in with what I think you were about to ask. Matt was talking about how you learn in Economics 101 about how the burden of higher inflation falls on lower income groups. Is that something that you're expecting? Clearly, this is getting the attention of politicians in various parts of the world. Is this something that you're going to focus on? That's going to be a focus? Do we think politicians getting involved in this inflation debate?
Yeah, I think it's starting to be a real political issue, especially in the US. But I do think that based on some preliminary academic work that I have seen, it's not the usual type of inflation that primarily weighs on low-income households, and that has to do with the fact on where we see most of the price increases, which is in goods prices in particular, and to some extent in services. It's the energy and the food price inflation that gets everyone. But again, this inflation pressures at the moment are driven by this very unusual restart, by the imbalances on the supply side of the economy, which we expect to resolve over time in the course of next year.
And how does that translate into a European context then? You mentioned in the United States. What about in Europe, where maybe the inflation pressure is a little more muted, but would you still expect it to have that same impact on different sort of economic groups?
Yeah, so it is, I think, similar in terms of the drivers, but the magnitude is very different, and the long-term or medium-term inflation outlook is different. The Federal Reserve expects, after the current bout in inflation to settle near its price stability objective. The ECB cannot say the same thing. Most likely inflation will ease back below 2%, and that means that the ECB's work isn't done here.
I think we found Matt's mic, so let's try again.
Well, hey, Elga, as we all wait for the White House to confirm its choice, I wonder if you think someone like Lael Brainerd can do more to address these issues than Jerome Powell is right now, because it seems like that's what they want. They want to find a more woke chair for Senator Warren.
At the end of the day, we need to recognize that all central bank decisions are taken by committee, and it makes more of a difference of sort of in terms of communication, who fronts the exercise. But I do think that at the end of the day, it's a decision that is very much driven by the composition of the committee and the views that a committee takes. And therefore, we need to acknowledge that, particularly at the Federal Reserve, we have a large number of open seats, and that means that we could potentially face quite a material change in the FOMC's views in coming months, going well beyond the appointment of the chair.
What do you think? I mean, when you were studying at Kiel in between sailing trips, what did you learn about fighting inflation? Or when you're operating as a member of the Shadow Council for the ECB, what do you think about fighting inflation in an age where it's caused by supply constraints? It seems so difficult to do with monetary policy.
Indeed, and I do think that central banks are going to face a much more difficult period going forward, potentially for an extended period of time, because over the last 3 decades, we had primarily demand shocks that monetary policy is very well positioned to address. Going forward, we might actually run into a larger number of supply-side shocks, which monetary policy can do very little about and faces very unpleasant trade-offs. That's really where fiscal policy and other economic policies that help to unclog those bottlenecks are required.
Elga, thank you very much. Thanks for spending time with us here on set in London. Elga Bash from BlackRock. Coming up on this program, the CEO of Goldman Sachs says market greed is now outpacing fear. Part of our interview with David Solomon from the Bloomberg New Economy Forum in Singapore. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie alongside Anna Edwards here in London, Matt Miller in New York. Okay, let's get back to Singapore then, where the 4th annual Bloomberg New Economy Forum has begun. Goldman Sachs CEO David Solomon warned about the potential rocky times ahead for markets as the economy recovers from the pandemic. Solomon spoke with Bloomberg's Francine Lacroix.
I think that we're turning the economic environment back on, but because of this crisis, we've had a massive amount of monetary and fiscal policy all over the world that's having an impact. It's having an impact on asset prices. It's having an impact on inflation, as you mentioned. I think markets generally, when I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. And generally speaking, my experience says that, you know, those periods are not long-lived. Something will rebalance it and bring a little bit more perspective. Certainly, given that it feels like inflation's rubbing above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
But are you expecting some kind of taper tantrum from the markets?
I'm not a good predictor. I've never thought of myself as a good predictor, but I certainly feel like the market anticipates higher rates at this point in time. The question is how much, how quickly. I don't think there's a chance that central banks can unwind this massive stimulus in a way that doesn't create some sort of a taper tantrum or some sort of a, you know, real shock to markets. But there's also a chance it can't be done that way. And, you know, I do think that people, you know, it's been a long time since we operated in an environment where the general trend on interest rates has been higher and the general trend on inflation has been above trend. I got out of school in the early 1980s, and generally we've had the opposite, you know, for that 35 plus years. And so, you know, I do think people don't remember when Paul Volcker raised interest rates by 300 basis points on a Sunday afternoon. So there are a lot of factors that will go into, you know, how this process plays out. It's unclear, but I certainly think that thoughtful market participants are thinking about it. In my conversations with big institutions, they're thinking about it and they're trying to balance the need to participate and have relative performance based on participation. And what happens as we unwind some of this and we rebalance a little bit.
So are you telling me that you're worried that, you know, markets are too cool about it just because they've made money for the last 10 years?
Well, I do think that, you know, generally speaking, everyone feels quite smart right now because most of the things that you invest in are going up. That's not the way it normally works. So you know, again, I'm not a great predictor, but my experience tells me this is a moment in time that's probably not a sustainable moment in time.
But then it would be what, an economic shock? So away from an inflation monetary policy, what could it be?
It could be a change in the perspective of the course of economic activity. It could be some sort of a geopolitical shock. It could be that something goes wrong with respect to our emergence from the pandemic and we have a different set of events that change the perspective. But all of this is based on kind of confidence and a forward view. And, you know, I would say at the moment the forward view is quite optimistic. If it stays optimistic and central bankers, you know, handle the withdrawal in an appropriate way with the right communication, there's a chance we can do it, you know, in a balanced way. There's a chance something could go wrong. Got to be prepared for both.
How do you prepare, actually, for both?
Well, you prepare by, you know, thinking about if the world looked differently, you know, how it would affect different assets and, you know, how would you feel if things were worth less? Yeah. Not worthless, but worth less. And so in that context, you know, we talk to our clients a lot about different scenarios, and, you know, we think a lot about our own balance sheet and, you know, our own propensity for risk as we try to navigate those things.
Really important conversation there. Goldman Sachs CEO David Solomon speaking to Bloomberg's Francine Lacroix earlier at the Bloomberg New Economy Forum. And Matt, interesting to hear them talk about the way things might go right or might go wrong as we see central banks globally dealing with the removal of the amount of stimulus they put into markets at the height of the crisis, and also talking about the need for long memories. And the more we can talk to people with long memories who remember the 70s, the inflation spike there, the early 90s, and the higher interest rate environment, we all learn something.
Well, I remember the early 90s quite well. I was a little young in the 70s, but I think we've all read the history, and I think a lot of people who focus on markets, whether they were there in the 70s or not, are really well informed. Paul Volcker raising interest rates quickly in a short amount of time is really interesting to bring up, because it does seem like many officials at the Fed and in other organizations usually err on the side of doing less than doing more. So they think they can get in less trouble if they do nothing as opposed to doing more.
And of course, Tom, relationships between the US and China, a really prominent topic at this forum, at the New Economy Forum taking place in Singapore.
Yeah, and they reiterated, Goldman Sachs CEO reiterated their commitment to China, but said, look, longer term, yeah, we may get pressure politically from Washington or Beijing, but for the moment, they have to be committed to that market.
Absolutely. We'll have plenty more interviews for you coming from the Bloomberg New Economy Forum throughout the week, including Bill Gates, the co-chair of the Bill and Melinda Gates Foundation. Also tonight on Peer-to-Peer Conversations, David Rubenstein sits down with the SEC chair, Gary Gensler. That's at 9 p.m. in New York. I wonder if they will talk crypto. This is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, but we still are seeing, like your reporters are seeing, some stock outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
You finally got your taste of MIT, so why did you decide to leave MIT and come in and run the SEC?
One, when a president asks you to do something, it's really hard to say no. But it's also just an incredible privilege and an honor to serve.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
China cannot develop in isolation of the world, and nor can the world develop without China.
I assume that Chinese leaders will work towards the maximum capability of their country. Our task as Americans and non-Chinese is to understand what we need to do to make sure that there is at least equivalence, and in no case subordination.
China needs to play by the rules. They need to respect our IP. They need to live up to their commitments. You know, right now, for example, in the so-called Phase 1 deal, where the Chinese committed to purchase a certain amount of aircraft and agricultural products. They're not doing that. They're not living up to their commitment.
You have to be able to sit down and work through, especially your market access issues when it comes to goods. So we would need some sort of ministerial dialogue to be able to work through that market accession.
Clearly, both major trading partners of ours, Australia's number one, China number two, we want them both to work together so that we don't get caught in the crossfire of tensions that still exist.
Various guests there speaking on China tensions and trade at Bloomberg's New Economy Forum, which is taking place in Singapore. Tom Keene joins us now, co-anchor of Bloomberg Surveillance. And Tom, I noticed very interesting takes there that are geographically divided. The closer you are to China, it seems you want to work with them. The further away you are from China, it's more a zero-sum game and it's sort of working against them. How is this going to play out?
Well, the way it's going to play out is the diplomacy that we see at the New Economy Forum, back to the reality of domestic and international Chinese politics. So those important communist meetings they've got coming up, government meetings, Politburo meetings over the next year, there's going to be a restructuring in China. The backdrop for that, Matt, is GDP. Let's look at the output numbers. Leland Miller, who's the smartest guy in the block in this, tells me you look at the relative move, not the actual level. In the broad span of 15 years is a move from 11% down to a 5% statistic on GDP with the gyrations of the pandemic in order. What's that trend? Well, there's a lot of people betting on a trend of a lower GDP. I would suggest many, many equity strategists are betting big on a Pacific Rim recovery.
Tom, it's remarkable, isn't it? 5% is the number that's being flagged then for 2022 amongst some houses. There was a time when below 7% was seen as a key line for the leadership in Beijing in terms of ensuring that stability. It's a time of common prosperity, of course. I talk to people on the ground in Beijing. They say they are taken by surprise, stunned by the changes around technology and real estate. How is this? Yeah, how are you making sense of this?
Let me translate this so everybody understands. When Tom McKenzie says he's talking to people on the ground, Matt and Anna, he's behind the red doors in Beijing talking to people about what's going on in the government. Tom, what's behind the red doors is what really matters to me, and they're looking again at the city-state structure. Let me ask you, Mr. McKenzie, because you're the smartest guy in this conversation. Does city-state still reign in China? Is the mayor of Shanghai the most powerful guy in the land?
Not anymore. Not anymore, not under this leadership, and that is the problem.
Big change.
When it comes to art, that is the big change, and that comes down to then how do you articulate this policy that's being constructed in Beijing at the local level? You can follow the leadership, but then you don't have the ability to adjust to local conditions, Tom.
See, Anna, how I got a red Bloomberg cup today? I mean, we're color coordinated on theme. It's just a great
I'm impressed. It's matching Matt's tie. Oh, no, he's gone yellow. That
no, that's
work.
okay. Matt and I got the flag going. It's great.
Excellent. Tom Keene, thank you very much. Tom Keene, co-anchor of Bloomberg.
We should talk to McKenzie more about China.
Let's do that. In fact, Tom has important things to say about what he's watching over in China very briefly right now.
Just very briefly on real estate, of course, we've been watching Evergrande and the pressures in the credit sector. We've got reports now that China is going to be allowing some property developers to issue asset-backed securities. That could alleviate some pressure.
Okay, so we continue to watch real estate over in China. Matt's watching the German COVID cases still on the move to the upside. I'm watching the latest from the Bloomberg New Economy Forum. It continues in Singapore. This is Bloomberg.
are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the quarter three was the quarter that was most affected.
One of the features of an economy that gets too hot is it does blow itself out.
Inflation is ultimately about fiscal and monetary policy.
The market's underestimating the extent of fiscal drag that we're going to face next year.
The training wheels are off, so to speak. Liquidity is slowly going to be drawn away through the course of next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Imminent is 4 days. It's 4 days. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market doing nothing this morning. Tom Keene, that Fed chair decision could be coming. I stress could be coming this weekend.
You know, come on, John. Last night I got up from the surveillance nap. I'm looking at...
Down in Washington indicating, Tom, that might be the case. That he hasn't.
She did. Let's get it done. I would suggest, John, with great respect to the president, he can't make up his mind.
The team down in Washington indicating, Tom, that might be the case. That he hasn't made a decision yet, and that's why we've got to wait.
He's allowed to make a decision. It's a big decision. Maybe we need to review that right now, John. Why is this a big decision? Not just about monetary policy, but posturing if things get worse. Do you go with a proven horse if things get worse, or do you go with a new girl on the block if things get worse? It's a tough decision.
With a six handle, Tom. Lisa, that's got to be the bottom line at the moment.
Yeah, I do wonder, though, at this point, how much the Biden administration is regretting not doing this earlier, because the conversation is not where they want it to be. The idea that everyone is mocking the idea of imminent being maybe 4 days, which is basically what everybody thought when they saw that announcement. And then you've got all of the senators and Congress people saying, look, you have a problem on your hands. You've got a messaging problem with inflation, and you've got a problem on your hands when we head toward the debt ceiling, John.
I'm going to say this with a smile on my face, but did you notice that Senator Manchin's going to meet with Chairman Powell later this week? And some people, Lisa, suggesting that maybe Senator Manchin will be the guy that decides who the next Fed chair will be.
Can we just call him President Manchin at this point? I mean, honestly, he's the one who's dictating a lot of the decision-making in Washington.
Things are getting better on one front, Tom. The president would like you to look at Los Angeles port chief comments on bottlenecks at the port. And the number of containers sitting on docks at the port in LA has declined 29%. The president retweeting that Bloomberg story yesterday, Tom. He wants us to focus on it. That is a little bit of ray of hope, a little bit of good news for this administration and for this country, this economy.
But the good news is out there, John, but the good news is also Home Depot, Citigroup raising their price target on Home Depot. And frankly, to me, that's linked right into the ports of Los Angeles and Long Beach. Dana Telsey's Joe Feldman, he raises his price target as well. It's all linked into a recovering America. And John, where you see a recovering America this morning, and I'm going to segue here, John, over to the United Kingdom, is dollar stronger, DXY through 96, euro weaker. And look at sterling off their inflation statistic.
Inflation at a decade high in the UK, and just maybe...
What's it mean?
Maybe it means a rate hike at the Bank of England next month. We'll talk about that a little bit later. Have you noticed what the story is, though, this morning, Tom? We're front-loading Christmas. We're front-loading Christmas. That's the story.
Yeah, we are. The
people getting on board with that.
The big story for me is, do you go with the big turkey or do you go with two small turkeys? And
are you getting the smoked one this year again?
No, I'm going out to a restaurant.
Well done.
Benoit, once
Good
more.
morning,
No
good
doubt.
morning, Benoit.
Of course. I've done that one with you before, Tom. Your equity market this morning shaping up as follows. We're down about 2 points. No drama. Negative 0.05%. Yields unchanged on 10s at 163.19.
Come on, the euro's drama.
I'm getting there. Euro dollar 113.10. We've come from 114 to 113, Tom, and now having a little look at 112. That's euro dollar. I'm surprised you're not excited about dollar lira. straight through 10 on a 7-day streak of Turkish lira weakness.
Idiosyncratic there, and Erdogan out with a headline this morning complaining again. But John, the euro weakness is an incredibly elegant chart, and off that point of November 9th, it's a 2.4% euro weakness, which is 63% annualized. That is an abrupt move, even for Kitchukes.
After having a look at 112 overnight, Lisa, 113.11.
I gotta say, Tom Keene is not necessarily the most predictable when it comes to which currency pairs he's focusing on, because I also thought he'd be focused on the dollar lira. However, his smoked turkey is pretty terrific. Okay, today, 8:30 a.m., U.S. October housing starts and building permits. Housing starts expected to show some strength as well as permits. This really goes to the issue of, yes, perhaps we're seeing some of the bottlenecks start to ease in the port of Los Angeles, but these are broad-based pressures and they are broad-based input prices that have been increasing. How much concern is there and how much does demand continue to outstrip that as people struggle to afford some of these houses? 10:30 a.m., we got a House committee holding a hearing titled Industry and Labor Perspectives, a further look at North American supply chain challenges. How much can they message that we are moving towards something better when it comes to alleviating some of these pressures? The problem is consumer sentiment, as read out by the University of Michigan survey, fell to the lowest since 2011. Can we alleviate that at a time when a lot of people say supply chain pressures are getting worse? And today, who is not speaking on the Federal Reserve? Honestly, John, the roster of speakers is almost borderline ridiculous. John Williams, Christopher Waller, Mary Daly, Raphael Bostic, Michelle Bowman, Loretta Mester. I mean, who is not speaking on a day when there's very little they can actually say, John? I mean, honestly, are we going to get any actual words, or is it just going to be noise?
You get to run the Fed. You get to run the Fed. You all get to run the Fed. Who wants to run the Fed? We all want to run the Fed. What a list, what a lineup coming up later. Lisa, thank you. I want to check out crude just quickly and take a look at what's happening with WTI and Brent too. Keep an eye on what's happening here. Brent crude, WTI, we're down to about 79.72 on WTI, negative a little more than 1%. Tom, the South China Morning Post raising the issue, the following issue, the issue of China joining the United States in releasing crude oil reserves. It was raised in the virtual meeting between Xi Jinping and President Joe Biden. That's one to watch.
That's one to watch. And of course, we get some conversational enhancement on that at the New Economy Forum of Bloomberg. This is something, folks, that's really put together over the year. And John, I thought what Dr. Kissinger said is, look, let's shape it up and let's get diplomatic.
Let's see if we get any follow through a little bit later. The commodity market, one to watch through the next couple of hours. Joining us now to kick off the equity conversation is Ben Laidler, global market strategist at eToro out of London. Ben, Santa came early this year. Is that your take?
Absolutely. November, December, generally the strongest months of the year, the so-called sort of Santa rally. But here we are, sort of middle of November, we're up 10% from, or nearly 10% from the sell-off in September. So I think this has been very front-loaded. And, we're up 25% for the year, and we never thought we were going to get here. We're sitting on our year-end target already. So, I think markets are very well supported. I see, good upside for next year. I would just, caution that, maybe we're not just going to keep rallying inexorably here. I mean, I think we've already had the Santa rally, and we're sitting on great gains, and I would take a little bit of consolidation.
The modest Ben Laidler. Let me make clear, folks, no one on Global Wall Street called for 3 years of double-digit return like Ben Laidler. He's not surprised. We're up 25%. Ben, what is a double-digit call for 2022, or do we finally get to a single-digit reality?
I think we're going to come pretty close to double digits. And just to put that in perspective, I mean, that would be your fourth straight year. And I think you've only ever seen that once in the last sort of 50 or 60 years. So really, we're sort of heading into uncharted territory. But I think it's very, very doable. And I think, the two drivers here, I think earnings expectations are just still far too low. In the US and globally, they're 7-8% for next year. I think you probably get double that when all is said and done. I think, GDP growth is nearly double long-term averages. I think we're seeing the resilience of corporate margins. We have a lot of sectors, a lot of these reopening sectors that still have, a long way to bounce back here. And I think valuations are going to come down a bit, but I still think they're going to stay way higher than sort of long-term averages. I think bond yields are going to go up a bit, but they're still a fraction of previous recoveries, and you've still got this huge tech sector. which just deserves to have very high valuations.
Ben, you said take consolidation at a little bit around the edges, given the fact that we've already front-loaded this rally. Where are you taking consolidation right now?
I think tech, I guess, would be the obvious place. I mean, we're neutral tech. Tech's done sort of very well here. I mean, we had this sort of everything rally, which I take a lot of comfort from, right? Because I think it's not the sort of one-legged stool we had sort of last year. But I'd be sort of pulling back a little bit on tech. I think the near-term story is this very strong growth reacceleration that we're having. I mean, you've seen it in the payrolls numbers. You saw it in the retail sales numbers yesterday. You've seen it in the ISM. I mean, you look at the Fed nowcast, GDP nowcast for the fourth quarter is nearly 9% growth. We had 2% last quarter. So I think, you need to be sort of pulling back on sort of defensives, things that aren't exposed to that, and really focusing on the sort of cyclicals, the commodities, the industrials, the segments of the market, the reopeners that are really sensitive to this very strong growth recovery that we're seeing. And I would also just say the market's passed this huge stress test. I mean, we were all worried about inflation. We were all worried about the Fed tapering. We were all worried about interest rates. I mean, we've just had tapering or announcement. We've had a big repricing of the Fed, and markets are yawning.
Ben, are you positioned for a repeat of Q1 this year? Is that it? Is that the playbook?
I think so, yes. I mean, I think, it's small cap. It's the reopening stocks. It's the sort of more cyclical sides of the economy. Who's got the most sensitivity to this growth rebound that we're seeing? And I still don't think it's priced. I mean, just more broadly, I mean, the earnings numbers are just far, far too low, even after, the fourth quarter of, very strong earnings beats we've just had.
The optimism of Ben Laidler of eToro. Ben, thank you, sir. Looking ahead, Tom, to another Q1, potentially that look like Q1 of this year. My question would be as follows, and I'm with Ben. We're seeing the re-acceleration in the economy. That's in the data. That's not crystal ball stuff. That's there for all to see. Can we get a repeat of Q1, and can it be more durable than what we saw in Q1, Tom? Because that story faded pretty quickly.
I'm going to go to the top line, which I would suggest in Christmas of 2018 was the top line for Ben Laidler when he made that call at HSBC. And to me, John, it is about the top line. We saw it with Home Depot. To an extent, we saw it with Walmart. Target's a mystery. We get them here in a bit. But I'm sorry, it's about top-line boom economy. As Ben mentioned, the Atlanta GDP number is still unimaginable.
Elisa, Ben talked about that stress test for this market. The issue is we're going to have that stress test now every single quarter for the next several quarters.
Not only that, but then the Fed has to respond to the ongoing strength that you continue to see in the earnings with holding tight. Right? I mean, basically, how much do they have to get a little more hawkish, and how much does that unravel some of these trades that Ben's talking about?
How long can they be patient for?
Yeah.
That seems to be the question. Your equity market unchanged on this S&P 500 this morning. From New York City, good morning to you all. Coming up in the next hour from the Bloomberg New Economy Forum, we'll be hearing from the Prime Minister of Singapore. Looking forward to that. From New York City, for our audience worldwide on radio and on TV, it is imminent. It is 4 days away.
I still can't spell it.
Imminent. We might hear who the next chairman, might be this chairman, of the Federal Reserve will be. This is Bloomberg.
With the Fast Fed News, I'm Rishika Gupta. President Biden is still deciding whether to reappoint Federal Reserve Chair Jerome Powell or replace him with Fed Governor Lael Brainard. The president is said to have ruled out other possible contenders. He told reporters to expect an announcement in the next 4 days. Senate Banking Committee Chairman Sherrod Brown says there's no doubt the Senate would confirm either candidate. In the UK, inflation climbed faster than expected to the highest level in a decade. That's putting pressure on the Bank of England to raise interest rates. Consumer prices rose 4.2% in October from a year ago. Higher costs for fuel, restaurants and hotels led the jump in prices. And China is speeding up plans to replace American and foreign technology. Bloomberg's learned that a secretive government-backed organization is certifying local suppliers in sensitive areas, from cloud computing to semiconductors. Roughly 1,800 Chinese makers of chips, PCs, networking equipment and software have been approved. And some tech giants see the metaverse as the next frontier of growth. Sundar Pichai sees Google's future in its oldest offering, Internet Search. The CEO of Google and its parent Alphabet spoke with Emily Chang for Bloomberg's New Economy Forum.
I've always felt, your market cap valuation is an effect of the value you provide. And I feel fortunate our mission is timeless. There is more need to organize information than ever before. I still feel search is our biggest moonshot as a company.
Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Msci Gupta. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now. It's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
China needs to play by the rules. They need to respect our IP. They need to live up to their commitments. You know, right now, for example, in the so-called Phase 1 deal, where the Chinese committed to purchase a certain amount of, aircraft and agricultural products, they're not doing that. They're not living up to their commitments.
Where is the follow-through? That was Gina Raimondo there, the US Secretary of comments from New York City this morning. Good morning. Tom Keene, Lisa Abramis and Jonathan Ferro. Your equity market unchanged on the S&P after a really stellar retail sales report in America. That conversation about higher interest rates back on the table in a big way after the past week. Inflation with a 6 handle. Growth is looking good. Yields are at 162.84. Around about 15 basis points off the highs of the year that we saw in Q1 of 2021. Euro dollar 113.14. We did have a 112 handle a little bit earlier, Tom. We'll talk about that a whole lot more through the next couple of hours. And in crude, a break of 80, 79.66 and down by 1.36%. A report from the South China Morning Post that the US and China have had a conversation, Tom, just a conversation about a joint effort to release crude reserves. No results, no follow-through, but the conversation reportedly there.
Well, the conversation there, and we'll have to see, of course, that huge point at Singapore and across the Straits of Malaysia, where the oil comes swinging around and up the Pacific Rim. We'll hear more about that at the Bloomberg New Economy Forum going on right now. Francine Lacroix leading the way there. Right now, leading the way in Washington, Anne-Marie Horton, our Bloomberg Washington correspondent. Anne-Marie, everybody's going anti-Fed on the Bloomberg every 4 minutes trying to find out when imminent it is. The other parlor game you can do, folks, if you're bored with Red Sox Hot Stove League, is go to the Congressional Budget Office website where it says CBO to release a complete cost estimate of Anne-Marie Horton's Christmas shopping by November 19th. We're all waiting on CBO. Greg Vallier says set yourself up for huge disappointment and the ability to raise tax revenues. How tangible is that?
Well, this comes down to potentially how much money, if you give the IRS, to really clamp down on making sure that everyone, especially this administration's, the very wealthy, are paying their taxes. And what we already are potentially going to expect is that the CBO does not match what the White House was telling these moderates. And that potentially could make it very difficult for these moderates to get on board and voting for Build Back Better. Now, we did hear, though, from the moderates that they don't want to put a red line in the sand with the media. So they want to wait and they want to look at those CBO scores before they move ahead.
Is there any history that politicians pay attention to what bright people at the CBO write and say?
They do, Tom, when it's convenient for them. So I think the CBO scores matter a lot when you're on the fence of something, or you need to, or you know you're going to have to go home and defend to your constituents why you voted for something. And I think with the inflation figures so hot in October, and that's really what the electorate is worried about, and what you see politicians speaking to, the CBO scores are coming at a very difficult time for some of these centrist, moderate Democrats.
All right, CBO estimates are one thing. An actual balance sheet is something else, and the U.S. balance sheet is looking a little shaky. I was trying to do the math. So they've got $369 billion in cash made available through extraordinary measures, used up about $182 billion of it, and now the U.S. Treasury Department has to transfer $118 billion to the Highway Trust Fund by December 15th, as per passing this law, and that 1 month following they had to do this. How close really are we to defaulting, putting aside what Janet Yellen is communicating?
So Janet Yellen gave her projections to the congressional leadership, and that's a new X date, let's call it, where we're going to get very close potentially to that cliff with the debt ceiling and reach that debt ceiling. And that's now December 15th, so a few more weeks out from December 3rd. Experts say it could be anywhere between the middle of December to even as far out as the middle of February. What we do know, though, is that this is just another litany of issues added to the list that the Democrats need to finish with less than 2 weeks, technically, of working days. It does seem like they're going to be having to work overtime here in Washington, and it's going to come right up to the end of the year to get a long list of things they have to get done. But this debt ceiling, of course, we know a month ago we were here at the same exact position, and we had the Republicans pave a way. Minority Leader Mitch McConnell allowed basically 11 Republicans to help the Democrats get this over the finish line. It's unlikely he's going to do that again.
Is there more cohesion among the Democrats now that they've passed the bipartisan bill?
I would say there's not, in the sense that they are still arguing over a number of issues. Build Back Better is going to be one of them. And then you also have the national defense legislation. This is a must-pass every year legislation, and you already see amendments being thrown at that. And also within the Democratic Party, some issues from the Senate and the House on what they think should go into that defense bill, especially when it comes to whether or not they should include the China competitive legislation that was passed in the Senate in June and is still waiting to be passed in the House.
Are you doing a Fed special this Saturday from outside the White House? Is that happening?
Yeah, we've gone from imminent to indecisive. And the president, by the way, said about 4 days. So I'm not even sure imminent means even 4 days anymore. But 4 days could potentially be Friday if you count yesterday as day one. But Friday, of course, is going to be the turkey pardon day.
You drunk the Kool-Aid down in Washington. Are you
Saturday is the president's 79th birthday. I do not expect him to announce the Fed chair on his birthday. So I think this is going to get punted into next week.
Okay. Anne-Marie.
It's great.
Thank you. With some analysis there. AMH down in DC. Anne-Marie, thank you very much.
John, you think we're doing a Fed show Saturday?
I think you might be. I'm off next week.
You're off
Do
next
you want me to
week?
join you? Do you want me to be on standby?
Like December 10th
I can be on standby for you.
Really?
I can be on standby.
From
Would you
Capri.
like that?
It'll be great. Yeah.
Sure, I'll do it remote. Let's have a look at what's happening in Turkey.
Please.
Dollar lira. I want to look at it over 5 years and then we'll do intraday. Over 5 years. The reason I want to look at over 5 years is just to show you that as recently as 2018, we had a 3 handle on this currency pair. Tom, we're through 10. And if you look at it intraday right now, this is the 7th straight session of a positive move on dollar lira. So that's record weakness on the Turkish lira. And here's a quote for you from the Turkish president.
Please.
He says the following: isn't the central bank independent? You say that the central bank is independent, so it should decide independently. And I think a lot of people in the market trying to answer that question, Tom. Is this central bank really independent?
Now, Dr. Larian using the Bloomberg here out on Twitter moments ago on lira. And John, what's so important here is this word pernicious. The chart, the log chart of trade-weighted lira is teach a course. It's incredibly elegant and persistent. There is a technical break point 7 years ago. Trade-weighted lira is down 77%, John, in 6-7 years.
Unreal, Tom.
It's unreal.
There is a huge economic experiment taking place with monetary policy.
That's one way of putting
Turkey.
it. I mean, talking about the idea that lowering interest rates will somehow curb inflation. And he says, who could defend interest? Well, you can defend the idea of higher interest rates if that curbs inflation and actually creates a better backdrop for your residents. He has his own view on this, though.
A dollar lira in and around 10.50. Coming up on the program, Lindsay Piegza, chief economist over at Stifel, as we break down the data over the past week, not just this week, but last week too. CPI flying, this economy re-accelerating, and yields picking up at the front end as well as the long end. 162.84 on 10s. Equity futures down a single point on the S&P 500, negative 0.03%. And very, very briefly, euro dollar with a 112 handle, now back to 113. From a beautiful New York City, good morning to you all on radio and on TV. This is Bloomberg Surveillance.
the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Live from New York City for our audience worldwide on TV and on radio. Your equity market totally unchanged after coming very close to all-time highs in yesterday's session. The S&P 500 down not even a single point. On the Nasdaq right now up 18, advancing 1/10%. On the Russell, the small caps up about a quarter. That's the equity picture. Here's the bond market story. 2s, 10s and 30s. Your yield on 10s, 162.84. On 2s, very close to the highs of the year as we start to have this bigger conversation about rate hikes in the United States of America. If you listen to Priya Misra and the team over at TD, they say wait until December 2023. That was the headline that came from our program in the last 24 hours. We're going to keep on talking about that big call from the likes of TD and others who think this Fed can remain patient. So who hikes first? If it's not the Federal Reserve, will it be, drumroll, the Bank of England? Switch at the board and get to cable. Your pound against the US dollar, 134.39. Positive by about 1/10% on the day. Tom Keene, the labour market flashing green. The CPI print this morning flashing green. Will the Bank of England go and hike interest rates in the middle of next month?
Well, we'll have to see. Of course, Priya Misra pushing against that. Really, our interview of the day yesterday, Priya Misra of TD Securities just flat out doing a Draghi and saying, John, what'd you think of that? Let's stop the show here for a moment. I thought it was a make-or-break career call by Ms. Misra.
I think Priya Misra is better than just a single call, Tom. So I don't know if it's make or break, but I think it's a big one. And what we're going to have to see, look, I think it all depends on how patient you think this Federal Reserve will be. And that's a guessing game, Tom. Yeah. You've got to guess as to whether this chairman is going to be committed to this framework. Whoever the chairperson is of this Federal Reserve will be committed to this framework and wait. Be patient enough just to sit this out and wait. And Tom, if you wait long enough, this economy will change. We know that. But can they wait? Can they sit through inflation that keeps pushing higher, a 6 handle in the past week?
And I go to GDP, which is a boom economy. Before we get to Dr. Piegza, I really want to show Target is doing a Home Depot. There's always some nuances here, but Target with over 400,000 employees, you talk about labor demand, Target here with bang-up earnings. I'm going to go right, obviously comp sales like Home Depot being a very nice beat, et cetera, et cetera. But what I'd really go here is, can anyone compete with Amazon? The digital experiment at Target is organized, acute. They are up 155% in the previous year, and right now up 29% on digital. To me, that's a telling statistic. Let's go right now to Lindsay Piegza, chief economist at Stifel, here on this. Lindsay, this is the transformation of the American economy. When you look at the GDP estimates, Atlanta, your own estimates, et cetera, do we underestimate the technology transformation is witnessed by Target?
I don't think
we're underestimating the support that technology and an increase in productivity is going to add to the economy, not only through the end of the year, but into 2022. But remaining at these lower GDP forecasts, I think it does recognize the loss of extraordinary fiscal support, which caused a boom in economic growth at the start of the year. So these other factors are helping to offset that, but it won't bring us to the 3, 4, 5, 6% that we saw at the start of the year.
What's your number then? I mean, are you glide path back to potential GDP on Abramowitz like 2%, or can you be higher, more optimistic?
I think I can be more optimistic through the end of the year. I think the back half of 2021 will average out to about 3%. But when we turn the corner into 2022, it's very likely that we revert back to that pre-pandemic level nearer 2%. Remember, the U.S. economy was already losing momentum as we were heading into the crisis. We were slowing from 3% in 2018 down to 2% by the end of 2019, early 2020. So going forward, barring the scenario of unlimited government spending and debt creation, there's little expectation, at least in my mind, that we are able to return to a more sustainable growth rate much beyond that 2% level.
Lindsay, just bring the time horizon all the way in to the next 3 months. I'm trying to understand this reacceleration in the US economy at the moment. Are we front-loading economic activity going into the holiday season? Do people get the message? Are they going out early and getting this done?
Absolutely. Look at retail sales yesterday, surging past expectations. Consumers right now are of the mindset, we better go out and buy what we can, because next month, prices are going to be higher if goods are available at all. So consumers are very aware of not only what inflation is doing, but what supply chain constraints are doing to product availability as we head into the key holiday season. Now, that's not to say that the consumer will fall off a cliff by the end of the year, but there's certainly a number of variables that are pulling forward that more traditional end of the year spending.
Is that evidence of the psychology, the psyche of the consumer in America changing, Lindsay? And what does that mean for your outlook?
I think in part it is. And I think this is also supported by the decline that we've seen more recently in consumer confidence, taking a big step in the wrong direction as consumers are reporting they're not only increasingly concerned about their current financial situation, but they're increasingly uneasy about the future of the economy, the future of their financial situation. And so consumers are really embracing a new thought process of, again, buy now because prices are on the rise.
Lindsay, when do we actually see that translate into the data of a weaker retail sales number or some evidence that perhaps the Fed can point to for their patience?
It is going to be a little bit of a double-edged sword, absolutely. So we're seeing stronger numbers in October. We're likely to maintain some moderate strength in November. But by the end of the year, if much of that spending has already taken place in the earlier months, it's very likely that December is on the weaker side of expectations. That being said, even if the Fed can point to a somewhat relatively slower pace of consumer spending, with inflation at, in some cases, 30-year highs, it's going to be very difficult for the Fed to backtrack on the taper process or postpone the first rate increase beyond the end of 2022. Now, I know there's several calls for 2023, but I remain very skeptical, as does the market, that the Fed will be able to maintain these very low rates for another year, let alone longer, again, with the backdrop of the PCE, the CPI, the PPI, regardless of your inflation metrics, suggesting that prices are extremely elevated.
Well, there was a story this morning on Bloomberg basically showing that the Chair Powell's own dashboard is flashing yellow. Basically, all 5 metrics he's pointed to are all showing signs of more sustained inflation. If this continues, what's the glide path for next year that you foresee? I mean, Jim Bullard was talking about potentially ending the taper in the first quarter. Is that feasible to you?
In terms of accelerating the process, absolutely. But the Fed would need to see very clear evidence that the economy is gaining momentum. Remember that the pathway that the Fed outlined was a guideline. It was not a commitment. So the realized pathway of the data is really going to drive the monthly reductions on the asset purchase side. Now, as far as liftoff, I think the Fed is facing a very delicate balance. On the one hand, yes, they want to control inflation. They want to keep inflation expectations in check. But at the same time, they don't